Good morning, students. Welcome you all once again on this virtual coaching class organized by Board of Studies of ICAI. I am CA Dr. Alok Garg. So, students, today we are going to talk about Ind AS 115, and today is the fourth class on Ind AS 115. And so, prior to today's class, we have already covered three steps of Ind AS 115 in the last three classes. So till now we have understood what is meant by income. So income is increase in net assets or income is increase in net assets. Okay. Other than by way of equity participation, equity shareholders participation. Okay. And what is the revenue? Revenue is the income which is happening in the ordinary course of the business, right? And we understood that in this particular standard, we need to talk about three aspects. One, which is revenue. What is revenue? Which is happening in the ordinary course of business. Second, there must be a contract. And third, there must be a contract with the customer. If these three conditions will satisfy, then that particular transaction will cover under Ind AS 115. And we have also understood that what is meant by identification of contract. I mean to say 5-step model. And under 5-step model, we have understood that there must be a contract with the customer. And for being a contract with the customer to be covered under this particular standard, there must be a 5 condition which needs to be fulfilled. Like we have discussed that the contract must be approved. The rights and obligation of each party should be identified. The payment terms should be clear. Okay. And there must be commercial substance of the transaction. For example, there could not be a barter transaction between the entities which are into the same line of business, right? For example, two grocery dealers are just exchanging rice and pulses with each other. So that kind of transaction is not covered under Ind AS 115. And the fifth one is the consideration, the collectibility of the consideration should be probable. It means there is an intent and ability of the customer to pay the consideration, right? So in that particular step one, we have also covered combination of the contract. I mean to say when two different contracts can be combined. And we have also discussed modification of the contract. So when a contract will be considered as a separate contract, or when a contract will be considered as an amendment in the existing contract, or cancellation of the existing contract and formation of the new contract. So we have covered these aspects in the step one of the step one of this 5-step model of Ind AS 115, identification of contract, right? So students, after that, once we have identified that yes, it is a contract to be covered under Ind AS 115, we need to see how many performance obligations are there, because this is a substance-based standard, and this standard is totally dependent upon the performance obligation. That what are the promises which have been made by the supplier, vendor, or service provider to the customer, right? So we need to understand how many performance obligations are there, what are the performance obligation, and what is a performance obligation. Performance obligation are the promises made by the supplier, vendor, or the service provider to the customer. And performance obligation are distinct goods or services, right? What is meant by distinct goods or services? These goods and services can be used separately with the readily available resources, or can be used by the customer at its own, right? Or these goods and services should be different, should be identified in the contract, and these goods and services should be distinct, should be different, should be separate as per the context of the entire contract as well. Okay. And you remember we have taken a lot of example like construction activities example as well. And when can we say that as per the contract these goods and services are different performance obligation? When there must not be a major integration, interdependency, customization of that particular performance obligation. Okay. If there is some activity which requires a major degree or a significant degree of customization, right? Significant degree of integration, interdependency is there. In that case, we cannot say that as per the contract, it is a separate performance obligation. If it is interdependent, it means it is not a separate performance obligation. These two are the single performance obligation. And we have taken a lot of example, and you can refer part 2 of this video on Ind AS 115, right? For having this concept in detail. Under performance obligation, we have also discussed that when there is a material right to refund. Okay. For example, today a supplier is selling goods worth ₹10,000, and he is also giving a right to the customer that if you will come tomorrow, I'll give you a 40% discount. Okay. So I'll not give 40% discount to every walk-in customer, but since you are the existing customer, and hence I'll give you 40% discount. So if there is a material right to refund, so that material right to refund is considered as a separate performance obligation, and some part of revenue needs to be allocated to that particular performance obligation, right? Then we have discussed if there is a right to return. I'm not talking about material right to refund. I'm talking about right to return. Okay. If there is a right to return, then we understood that for right to return, we need to we need not to recognize revenue till the time that right to return is completed. Either the customer has actually returned the product or the time period has been elapsed, right? In that case, we have to recognize a right to recover asset, and we have to recognize a refund liability, right? We have also discussed a concept of warranty, okay, and we have discussed if there is an assurance type warranty which is given at the time of product, which is combined with the product. For example, when you buy a laptop, there is a 1-year warranty attached to the laptop, right? If it is a assurance type warranty, that is not considered as a separate performance obligation. For a service type warranty or for a different warranty, it has to be considered as a separate performance obligation, provided that warranty has been sold apart from the product. Okay, for example, when you go to buy a electronic product, then shopkeeper says that if you want to take an extended warranty, you have to pay me 5,000 rupees, right? It means the warranty is getting sold differently from the product. It is not inherent with the product, it is sold differently. That warranty is out of the legal obligation. Okay, so that is not a legal warranty. That warranty should be for the extended period, for the longer period of time, right? If these conditions are fulfilled, these warranties are called as an assurance type warranty, and the revenue related to the assurance type warranty has to be recognized separately as a separate performance obligation, right? So we have discussed about these aspects in the step 2. In the step 3, transaction price. So once we have covered that, yes, it is a contract, comes under the purview of 115. Yes, these are set of performance obligation, like 5 performance obligation in the contract. Now we need to understand what is the transaction price, and this was a step 3 of Ind AS 115. And in step 3 of Ind AS 115, we need to understand what is the transaction price, and we have discussed in the part 3 in the previous lecture that transaction price could be fixed price, fixed consideration, as well as variable consideration, right? So transaction price is the price of the entire contract. Okay, so when we need to identify transaction price, there are 4 aspects of it. 1, fixed consideration is always fixed in the contract. There is no problem regarding to the fixed contract price. But coming to the variable consideration, first of all, variable consideration is something which is dependent on the future outcome or future event, right? Which may be uncertain, right? And as far as variable consideration is concerned, of course, it is depending on the future outcome. So you need to estimate the variable consideration, right? And while estimating the variable consideration, you need to consider all the constraints. When I say constraints, all the limitations, all the obstacles, okay? And you need to be doubly sure that whatever I am recognizing, there must not be a significant reversal in the revenue going forward, okay? So what does it mean? It means that if today I am estimating that I'll get an incentive of rupees 2 lakh apart from the fixed consideration of the contract, I'll get an incentive of rupees 2 lakh for the early delivery of this goods and services, right? So when to recognize this 2 lakh, at the time of inception of the contract, while estimating the transaction price, I need to estimate this 2 lakh. I need to take this 2 lakh into the transaction price only when I'm doubly sure that yes, I will be able to receive this 2 lakh, right? Or whatever amount I'm sure that whatever amount I will be able to collect, I will be able to recover, I will be able to get this money. So I need to recognize that variable consideration only as a revenue. So estimation of variable consideration is very important. And in the last class, we have discussed how to estimate the variable consideration. We discussed we need to apply the statistical approach. We need to apply the expected value approach. And what is the expected value approach? And we have discussed that expected value approach. While estimating the expected value approach, we need to see whether there is a multiple outcome of a single event. For example, there is 20% chances that yes, I'll receive 2 lakh rupees. There are 30% chances I'll receive 1.5 lakh rupees. There are 40% chances I'll receive 1 lakh rupees. There are 10% chances I'll receive nothing. So there are multiple outcome of this particular event, and hence in this kind of situation, we need to apply weighted average approach, or we need to apply probability weighted average approach. Okay, so we need to multiply the consideration, expected consideration, multiply by the chances, and the total of it will give you the expected value as per the probability weighted approach. But if it is a binary outcome, I mean to say, yes, 70% chances that yes, I'll able to receive 2 lakh rupees, but 30% chances I'll not be able to receive. So there is only 2 outcome, I'll receive, I'll not receive. Okay, in the binary kind of outcome, we need to apply most likely approach. What are the best chances that I'll get or I'll not get? Okay, so in this case, 70% are more than 30%, more than 50%, right? So it means more likely than not, I'll receive the money. Okay, so in this case, entire 2 lakh has to be considered as a variable consideration. So we have discussed in the last class, variable consideration could be bonus, could be incentive, could be penalty. Okay, so something which is depending on the future outcome and something which is in addition to the fixed consideration, right? So my dear friends, in the last of more than 12 months, between the amount received from the customer and the performance obligation satisfied, if there is a time gap between these two aspects, amount received and performance obligation satisfied, for more than 12 months, it means you need to see whether there is a significant financing component. For example, today the customer is getting a delivery of the goods and services from me, and the current price is 1 lakh rupees, the standalone selling price is 1 lakh rupees, and the customer is giving me the money, and the customer is paying me after 1 year. Okay, for example, 1,10,000 rupees. It means that this customer is, first of all, there is a time gap between the delivery of the goods and services, I mean to say satisfaction of performance obligation, and payment of goods and services for more than 1 year. So of course I need to see whether significant financing component is there. Then I need to see whether this interest which is getting charged, of course, difference between 1 lakh and 1,10,000. So there must be a 10% of interest. I need to see whether it is a market rate of interest. When I say market rate of interest, you need to apply the incremental borrowing rate, right? Incremental borrowing rate. So whether it is at incremental borrowing rate, if answer is yes, you need to apply the interest accounting in this particular transaction. But for example, the customer is delaying in the payment, or for example, the customer is paying in advance, in addition to the significant financing component. It means the reasons other than the financing component. In that case, you are not required to recognize this interest part. Okay, for example, the customer is ready to pay now, but the supplier is insisting the customer that don't pay me right now, just pay me after 1 year. Okay, due to XYZ reasons. Okay, so the supplier is deferring or postponing the payment, right? Or second example, the customer has paid outright today, but the customer himself has asked supplier, please deliver me goods after 1 year. Okay, so the customer has deferred or postponed the delivery. Probably the customer does not have a space to put that particular product or machinery in their premises, and hence customer has postponed the delivery, right? So if these are the cases, in that cases, it will not be considered as a financing component, and the entire money which is received by the customer has to be recognized as a revenue, right? The third one, while assessing the significant financing component, for example, the incremental borrowing rate is 10%, but the vendor is only charging 1%. For example, the transaction price, or let's say standalone selling price today is 1 lakh rupees, right? After 1 year, the customer is paying 1,01,000 rupees. So 1% could not be a financing component, right? So 1% could be a convenience fee, could be a administration charges, or could be something else, right? So in this case, this should not be a significant financing component. So you need to see what are the reasons behind this 1,000 rupees. Of course, it is not a significant financing component, but because it is not at a market rate of interest, it is not at an incremental borrowing rate, right? So you need to see these kind of condition which we have discussed in the last class, and we have also discussed the concept of non-cash consideration in the transaction price. If there is a barter transaction, of course, this barter transaction should be not with the entities which are into the similar line of business. If the entities which are into the similar line of business, this barter transaction will not be accounted for under Ind AS 115. Why? Because this is not a revenue transaction, because this lacks commercial substance, right? So probably if these two entities are into the same line of business, probably they are just doing this transaction for inflating their revenue, right? So this will not be considered as a revenue. Okay. So in case of a non-cash consideration, for example, an entity is selling goods on a barter basis, or an entity is selling a goods in receipt of equity share of the customer, or in receipt of the other goods and services from the customer. In that case, the revenue needs to be recognized on the basis of fair value of the goods received. If the fair value of the goods received are not identifiable, in that case, you need to recognize at standalone selling price, which is of course a fair value of the goods or promises delivered, of the goods or services delivered. So this part we have discussed in the last class. Now, the fourth and the last part of the step 3, which is determination of the transaction price, is consideration paid or payable to a customer. So guys, this was the revision of the last 3 classes. Let me just look at the ICAI query box. If there is any query, then I'll discuss that. Otherwise, I'll move on. So Sairam is asking, I have doubt on illustration number 7 and 9 shown in page number 3.16 and 3.17 related to separate contract. Why not considered as separate contract? In 7 there is considered as separate contract, but same in case in 9, but there is considered as single contract. Why? So let me open first of all Ind AS 115 study material. So let me share my screen, and I hope this study material is visible to everyone. Yeah. So illustration number 7 is saying that an entity promises to sell 120 products to a customer for 1,20,000. The products are transferred to the customer over a 6-month period. The entity transfer control of each product at a point in time. So of course, these 120 products are the distinct products. I mean to say, for example, these 120 products are nothing, 120 mobile phones. Okay. So every mobile phone is a separate mobile phone, right? Separate usability. And the price is the 1,000 rupees per product. The entity transfer control of each product at a point in time. After the entity has transferred control of 60 products to the customer, the contract is modified to require the delivery of an additional 30 products, a total of 150 identical products. So after 50% of the consignment delivered, so the customer approached the entity and customer asked for additional 30 products, right? To the customer at a price of 950 per product, okay, which is the standalone selling price for such additional product at the time of placing this additional order. And so earlier 120 product, 120 mobile phone was selling at the rate of 1,000 per product. That was the fair value at that point of time. But subsequently, after delivery of 60 products, probably the price has gone down and this 30 product has been additionally ordered at 950 per product, right? We are not saying that this 950 is for the entire consignment. Only for this 30 additional mobile phones, these are selling at 950 rupees per mobile phone, right? And in the question, it is mentioned that these 30 products are not initially included in the contract. And the second, it is mentioned that for this 30 additional mobile phone or 30 additional product, the price which is 950 rupees is the standalone selling price. It is the market price. It is assumed that additional products are contracted for a price that reflect the standalone selling price. Okay. It is given in the question. So my dear friends and Mr. Sairam, if you will refer the part 1 of Ind AS 115 in detail, I have explained that when there is a addition in the scope of the contract by way of additional goods and services, by way of additional distinct goods and services, of course, this 30 product or 30 mobile phone are different. Am I right? Am I right? If everybody has to use one mobile phone, so these 30 mobile phone can be used by 30 different persons, right? So first of all, there is an additional goods and services. There is an additional goods and services which is distinct, which has its own usability, right? Which is not depending on the usage of the other products and services. It is clear. Second, standard says that if the additional goods and services are sold at their standalone selling price, although this contract is getting modified, but the additional goods and services are getting sold at a fair value at a standalone selling price at the time, at that point of time when the additional goods and services are getting ordered, right? So in this particular case, when there are additional goods and services, and when the additional goods and services represent their standalone selling price, represent their fair value, in that case, that contract has to be considered as a separate contract. That contract has to be considered as a new contract. Okay, that contract is not to be clubbed as an existing contract or modification of existing contract. Rather, this 30 products at their fair value has to be considered as a new contract, not a modification in the existing contract, right? I hope it is clear, Sairam. Yeah. Coming to the illustration number 9, because Sairam was saying, sir, illustration. I have also issued in illustration number 9. Sairam, in illustration number 9, if you see this particular case, Growth Limited enters into an arrangement with a customer for infra sourcing team. Based on its experience, Growth Limited determined that customizing the infra will take approximately 200 hours in total to complete the project and charges 150 per hour, right? So Sairam, this is a construction related activity when a contractor is developing an infra, right? And contractor has told that this will take 200 hours and the price is 150 per hour, right? But after 50% of the works delivered, 50% of the activities are completed, I mean to say, after incurring 100 hours of time, Growth Limited and the customer, the company and the customer agree to change an aspect of the project and increases the estimate of labor hours by 50 hours at the rate of 100 per hour, right? So they have changed some aspect. For example, when you are getting the construction of your house, so you are asking the contractor to please double coat the paint on the walls, right? So tell me whether on the first side, when they have single coated the paint of the wall and you are saying for double coating, it will take extra time. It will take extra time, right? Can you say that when they are doing the double coating painting on the wall, can you say that it is a distinct goods or services? It will give you a different usability. Can you say that? So first of all, you have done a single coating, then you are asking for a double coating. So this two activities are considered as interdependent activities. Okay. So in recurrence of the past activity, right? Because these two different, single coating and double coating, will not give you a different uses of the product, different utility of the product, right? So in this particular case, the extra work, because this is entire construction activity, okay, and once this activity will completed, you can say that yes, this entire performance obligation is one performance obligation. So prior to modification and after modification, the goods and services are interdependent with each other. First of all, when these goods and services are interdependent with each other, you cannot consider the change in the contract as a new contract or a separate contract. Rather, it is a modification of the existing contract, and you need to apply a cumulative catch-up approach. And what is the cumulative catch-up approach? So in this case, if you will see that the customer has increases the estimate of labor hours by 50 hours at the rate of 100 per hour. So in this case, you need to see this contract as a single contract, and you need to calculate the transaction price as a single contract, right? So in this case, the first 200 hours, the price was 150. So cost was 30,000. For next 50, 100. So it is 5,000. So for total 250 hours, the consideration is 35,000. So the rate comes out at 140 per hour. So going by the cumulative catch-up approach, what revenue need to be recognized? You have already recognized 100 multiplied by 150, but it should be 100 multiplied by 140. So there must be adjustment in revenue by rupees 1,000, right? So you need to reverse the revenue by 1,000 and you need to create a liability for that, right? Okay. So I hope, Sairam, you are clear on this. And if still you are not clear, I would request you to please refer part 1 of Ind AS 115. Okay. So in that part, you will get a clarity that how this combination of the contract, modification of the contract needs to be accounted for. So let me just see the other queries. If there are other queries, so I'll cover that. After that, I'll move on. Namita is asking, sir, if A Limited offer product at rupees 100, but on delivery, as per its business practice, it collects only rupees 90. Will it amounts to variable consideration? So Namita, of course, it is a kind of a discount, right? So for example, the price is 100 rupees, and as per the business practice, it will collect 90 rupees. So revenue has to be considered at 90 rupees, right? In expected value, why we also consider 0% probability despite of its effect is nil on the final answer. So Namita, its effect will not be nil because, for example, there are four outcome. Let's say 50% chances 1 lakh rupees, 20% chances 50,000 rupees, right? And let's say 20% chances 25,000 rupees, 0% chances 0 rupees. Okay, so the thing is, first of all, you need to complete it to 100%, right? In the examination, you have to show it as 100%, right? So although you are right that the impact is nil, but for the sake of completeness, you have to see what are the outcome for the entire 100%, right? So the presentation should be like that. Jay is asking, sir, in case 1,01,000 contract instead 1,10,000, will significant financing component will be found by discounting at 10%? Yes, Jay. If it is let's say instead of 1,01,000, the vendor or the supplier, or let's say the customer is paying 1,10,000, it means there is a significant financing component, because 10% is, of course, 10% is more than a market rate of interest, or it is a market rate of interest, right? Jay is saying for barter transaction, no revenue will be booked. Yes, for barter transaction, if it is with the entities into the same line of business, then no revenue will be booked. But if there are different entities, I mean to say, for example, DLF Limited, which is into real estate, and it is selling a flat to the Mercedes, and Mercedes is into the automobile, right? So in this particular case, this is a barter transaction, but in this particular case, DLF will recognize revenue on the basis of the fair value of the car, right? And Mercedes will recognize revenue on the basis of the fair value of the flat, right? So in case of a barter transaction happening with the entities which are not in the same or similar line of business, in that case, revenue has to be recognized on the basis of fair value of goods received, right? If fair value of goods received is not identifiable, then fair value of the goods transferred. So Namita is saying, sir, if we exchange rice with pulses, then commercial substance exists, as it is not a similar line of business. So why you said no commercial substance, Namita? I have told that, for example, there is a grocery shop, two grocery shops are there, and they are exchanging rice and pulses with each other. So both are selling rice and pulses, right? So both are in the same line of business. But for example, one is a rice dealer and the other is a pulses dealer, right? In that case, of course, they are not dealing in the same commodity. In that case, there could be a commercial substance exist, and there could be a revenue. Okay, understood? Is it clear to everyone? Guys, I hope my Excel file is visible to everyone. Okay, thanks Utkarsh for confirming. Yeah, so now I am coming to the fourth part of transaction price, determination of transaction price, and the fourth part is consideration payable to a customer, right? So friends, till now we have heard about that, of course, the consideration is payable by a customer. Okay, but what happens if the entity which is selling goods to the customer is paying a consideration to the customer? In that case, what happens? And can you give me an example for the cases where the consideration is payable by a customer? Sorry, consideration is payable to an entity. Consideration is payable to a customer by an entity, right? For example, you all have used Paytm, right? So while using a Paytm, so in the earlier scenario or even today, for example, if you're buying a product from Paytm, okay, so in that case, you will get a cashback, right? So instantly you will get a cashback, right? And I still remember So earlier when I was doing a electricity payment or telephone payment from the Paytm, I got a cashback of 10% or 20%, whatever offer which was going on, right? Now the question arises, if I am paying 100 rupees to the Paytm and Paytm is giving me back 10 rupees instant, okay, as a cashback. Now the question arises, this 10 rupees is something which is payable to a customer, okay, by an entity. Or you must have seen, while while just buying a packet of chips, or let's say kurkure or something like that, so you will find a scratch card, okay, on the packet of the on that packet, right? And while scratching that scratch card, you will get it, you will found there is a 10 rupees of cashback, there is a 5 rupees of cashback, right? And when you go to the shop, you will get a 5 rupees or 10 rupees on that, okay? Or for example, when you put the when you scratch that card and there is a code, when you put that code on Paytm or something like that portal, you will get a 5 rupees or 10 rupees in your account, right? So what is that? So this is something which is payable to a customer by an entity, right? So in such cases, if an entity is paying something to a customer, whether the entity will recognize it as a cost, I mean to say as an expense, or entity will recognize that as a reduction in the transaction price, as a reduction in the revenue. Okay, so what will happen? So my dear students, what is the guidance and why these guidance are important? The guidance are important. First of all, there could be two scenario. One, the entity will recognize revenue at 100 rupees, for example, and the entity will recognize a cost of rupees 10, right? So revenue 100, cost 10, or expense 10. Am I right? Expense 10 rupees. What is your profit? Your profit is 90 rupees, right? So first scenario is revenue could be 100, cost could be 10, and profit is 90. This is the first scenario. What could be the second scenario? The second scenario could be, this is the first situation. The second situation could be revenue could be 100, okay, cost revenue is 100 minus 10, so I'm reducing the transaction price or revenue straight away, so there will no cost and the profit is 90, right? So in the first scenario, if you see, my revenue is inflated by 10 rupees and my cost is also inflated by 10 rupees, right? So if I have to show a higher top line, I'll go by this approach, okay? And if I'll go by the second approach, of course, my revenue will be less by 10 rupees and there will not be any cost or expense, right? Now the question arises whether this presentation is at the mercy of the entity. I mean to say, if I as an entity wants to inflate the revenue, I'll show it as a first situation. And you, for example, Sairam as an entity does not wants to overstate the revenue and cost, so he will show the second situation. Is it right? No, it is not right. So in every country, there is a gap, generally accepted accounting principle, and these accounting standards are part of the gap. And these accounting standards provide accounting guidance. And what is the accounting guidance provided by this Ind AS 115 when you are paying a consideration to a customer? In that case, this guidance says that you need to see whatever money you are paying to the customer, is it due to the distinct goods and services? Is it due to the distinct goods and services? So for example, in this particular case, the customer has paid you 100 rupees and you have given a cashback of 10 rupees. So whether that cashback of 10 rupees is a different goods or services, answer is no. There is no different goods and services. This 10 rupees is related to this 100 rupees transaction, right? There is no different goods and services. You have not given a discount coupon where you are saying that you will be receiving a discount on the next purchases, right? If this is the case, of course, this will be a different goods and services, distinct goods and services. You are giving a different right. But here, this transaction is related to the 100 rupees transaction, and hence it will be considered as a reduction in the transaction price, reduction in the revenue, right? So in this case, what will be the appropriate treatment? The appropriate treatment is the second treatment, right? The appropriate treatment is the second treatment. Understood? So this will be the appropriate treatment. So So in this particular case, what is the guidance? The guidance is, if an entity is paying a money to the customer, paying a consideration to the customer, in that case, you need to understand whether that consideration is getting paid for the additional goods and services. If answer is yes, then it has to be recognized as a cost. I mean to say situation number one, and the revenue has to be recognized at a gross value. Second example, there is a company which is selling televisions. Okay. So for example, I'm dealing into furniture. I'm a furniture dealer. I went to this shop for buying a television. Okay. So I have bought a Samsung television worth rupees 1 lakh, right? So when I was paying 1 lakh rupees to this particular dealer who is selling me the television, so while I was discussing with him, so I told him that I am also a furniture dealer and my shop is just in the just opposite to your shop in this particular market, right? So he told me, oh ho, so you are a furniture dealer. So I am in need of 2 chairs and 1 table, right? I told you, okay, I can deliver you 2 chairs and 1 table. And he asked me, what is the price? So I told him that the price for 2 chairs and 1 table is, let's say, 15,000 rupees, right? Now the question arises. So he told me, okay, so I was paying him 1 lakh rupees and he also wants 2 chairs and 1 table from me as a customer. I'm a customer. I'm buying a television from him. So in this particular transaction, he told me that, okay, just take 15,000 for this chair and table. So net, he asked me to pay me 85,000 rupees, right? So I, as a customer, paid 85,000 rupees for buying a television. Is it the only transaction? In this particular case, I am buying a television worth rupees 1 lakh rupees and he is buying a furniture worth rupees 15,000 rupees. So I am paying him 1 lakh rupees. So on the face of it, it is looking like a net transaction of 85,000 rupees. But this is not the case. There are 2 transactions involved in this particular case. One, I am paying him 1 lakh rupees and he is paying me 15,000 rupees. So I am his customer and he is paying 15,000 rupees to his customer. Now tell me whether this television vendor has to recognize revenue as per the situation number 1 or as per the situation number 2. I mean to say whether this television vendor has to recognize revenue at rupees 1 lakh or he has to recognize at 85,000. Tell me what is the right scenario. For understanding what is the right scenario, whether it is 1 lakh or 85,000, you need to understand the amount which is paid by this television vendor to its customer. Is it for the distinct goods and services? Answer is yes, it is for the distinct goods and services. And when it is for the distinct goods and services, in that case, revenue has to be recognized on a gross basis and cost has to be recognized on a gross basis. Okay. So for this kind of furniture, the cost has to be recognized for 15,000 rupees, right? The cost has to be recognized for 15,000 rupees and the revenue has to be recognized at 1 lakh rupees. So when there is a consideration payable to a customer and there is a distinct goods and services, in that case, revenue and cost has to be recognized at net. Okay. And when there is no distinct goods and services, then the consideration payable to a customer has to be netted off from the transaction price. Okay. I hope you all have understood this aspect. Yeah. Third example, consideration payable to a customer. Okay. Third example, in case of a consideration payable to a customer, right? For example, PepsiCo entered into a contract with a Big Bazaar, or let's say DMart. Okay. So PepsiCo entered into a contract with Big Bazaar, and Big Bazaar told PepsiCo that I can sell 1 lakh quantity of your of Pepsi bottles. Okay. Big Bazaar said to PepsiCo. PepsiCo was very happy. So Big Bazaar will be able to sell 1 lakh quantity of Pepsi bottles, right? But PepsiCo is saying to Big Bazaar, Big Bazaar is also saying to PepsiCo, I don't have place, I don't have, my shelves are very small and it does not cater to your Pepsi bottles, right? And I have to incur some expenditure which I can't. So PepsiCo is saying, okay, for modification of the shelves where you need to keep the Pepsi bottles, I'll pay you 1 lakh rupees, right? I'll pay you 1 lakh. So with this money, you can just modify yourself and you can keep your Pepsi bottles, right? You can keep the Pepsi bottles. So my dear friends, you all have visited these departmental stores, right? These malls, okay? And you have seen that the various brands, the goods of the various brands has been kept in their shelves, right? So in this particular transaction, for example, the PepsiCo is selling 1 lakh Pepsi bottles at a price of, let's say, 1 crore rupees. And PepsiCo is also paying 1 lakh rupees upfront to the customer. Now the question arises whether this 1 lakh rupees as a PepsiCo P&L account, whether this 1 crore rupees has to be shown on a gross basis and 1 lakh rupees has to be shown as a cost or an expense, or whether PepsiCo will record a revenue of 99 lakh rupees, which is 1 crore minus 1 lakh rupees. What is your view? So Big Bazaar is ordering 1 lakh Pepsi bottles from the PepsiCo India Holding Private Limited, and PepsiCo India Holding Private Limited is paying 1 lakh rupees to Big Bazaar. The transaction price is 1 crore rupees, which is payable by the Big Bazaar, and PepsiCo is paying 1 crore rupees is payable by Big Bazaar, and PepsiCo is also paying 1 lakh rupees to Big Bazaar. So there are two transactions. First, Big Bazaar is paying 1 crore rupees to the PepsiCo. Second, PepsiCo is also paying 1 lakh rupees to Big Bazaar. Now the question arises whether the revenue in the books of PepsiCo will be recognized at 1 crore rupees with a cost of 1 lakh rupees, or revenue has to be recognized for 99 lakh rupees, which is net of this 1 lakh rupees. What is the right answer? Guys, what is the right answer in your view? Jay is saying 99 lakh rupees. Utkarsh is also saying 99 lakh rupees. Mani is saying 1 crore rupees. Mani, why 1 crore rupees? Whether this 1 lakh rupees, which is paid by PepsiCo to Big Bazaar, whether PepsiCo is getting any different goods or services, whether PepsiCo will be able to control those goods and services, whether PepsiCo will be able to get the benefit of those goods and services. Answer is no. There is no distinct goods and services. PepsiCo is just paying 1 lakh rupees for modification of the shelves, right? Where the Big Bazaar will keep the Pepsi bottles. So it is not a distinct goods and services, and hence in this particular case, it will be considered as a reduction in the transaction price, and hence this 1 lakh rupees has to be netted off with the transaction price of the PepsiCo, which is 1 crore rupees, right? Right. So Namita, what is your view? 99 lakh or 1 crore? Sai, what is your view? Right, Samiksha, it is 99 lakh. Good. Fourth example. Same example. Have you visited Shopper Stop? Have you visited? So when you go to the Shopper Stop, you will find there are sections of different brands. There are dedicated sections of different brands. Okay. For example, when you go to the section of Ellen Solly, you will find the Ellen Solly apparels, purses, and accessories only, which belongs to the Ellen Solly. And when you go to the next section, you will find there are Skechers section where you find the shoes and slippers for Skechers, right? When you go to the next section, you will find everything relating to Louis Philippe. When you go to the next section, probably you will get a specific items relating to the Nike, Adidas, right? So again, this Ellen Solly went to Shopper Stop, right? And Ellen Solly has asked Shopper Stop that Mr. Shopper Stop, you are my customer, right? And Shopper Stop is saying, yes, I am buying, let's say, a product worth rupees 20 crores every year from you, right? So he said, fine. And and this Ellen Solly is saying Superstop that Mr. Superstop, I need a section. I need, let's say, 200 square feet section at the entry gate. Okay, so whenever entry gate is there, you need to install my thing at that particular place. Okay, and you cannot move this from, you cannot move this place to any other brands without my permission, right? So first, this entire 500 square feet place, or let's say 200 square feet place, is dedicated to me. At that place, you need to put the hoardings, or you need to put the signboards which is relating to the Ellen Solly, right? You need to keep the Ellen Solly. You need to keep this Ellen Solly. Only Ellen Solly products in that particular place. Okay, so that I will have a better eye on the customer. So whenever customer will enter, they will find that Ellen Solly's brand is there, right? And I'll put my person at that particular space also, right? So a person from Ellen Solly will be there. So guys, in this particular case, Superstop is paying 20 crores to the Ellen Solly, and for this specific demand, Ellen Solly is paying 5 lakh rupees to Superstop. Have you understood me? So Superstop is a customer for Ellen Solly, and customer is paying 20 crore rupees in a year to Ellen Solly, and Ellen Solly is paying 5 lakh rupees to this customer. In return of, a separate section has to be given to the Ellen Solly, and that separate section has to be at a specific place. Okay, and the control and right of that place is lying with the Ellen Solly, right? And there is a person who is from the Ellen Solly who will monitor that thing, and who will be there for selling of goods and services, for selling of goods, not services, right? And the right and control lies with the Ellen Solly for that particular section, dedicated area, dedicated section. Now the question arises, whether the revenue in the books of Ellen Solly has to be recognized at 20 crore rupees gross with a cost of rupees 5 lakh, or revenue in the books of Ellen Solly has to be recognized at net, I mean to say 20 crore minus 5 lakh, which is 19 crore 95. What is your view? So you need to see whether this 5 lakh rupees is for distinct goods or services, whether I am getting any rights, whether I am getting any control for this 5 lakh rupees which I am paying to the Superstop. Answer is yes. You are getting a separate section, and of course, while you are getting a separate section, the rights and benefits lying with you only, I mean to say Ellen Solly. So in this particular case, this 5 lakh rupees Ellen Solly is paying for the dedicated space, so that the Ellen Solly will get a larger benefit out of that particular place, and the rights and benefits lies with the Ellen Solly only. The control lies with Ellen Solly only. So in this particular case, the revenue has to be recognized at 20 crores in the books of Ellen Solly, and the cost has to be recognized at 5 lakh rupees in the books of Ellen Solly, right? Is it clear? Is it clear to everyone? Guys, is it clear to everyone? So friends, what is the guidance? First of all, please write down, if the consideration payable to a customer, if the consideration payable to a customer results in no distinct goods or services, then no distinct goods or services, then the amount payable should be reduced from the revenue, oblique transaction price, right? Oblique transaction price. So while determining a transaction price, such amount should be reduced. if it is a distinct goods and services, results in distinct goods and services. Example, my television and furniture example. Okay, so the earlier example was for modification in shelves, right, which is not giving any control to the brand. But in this particular case, this control is lying with the Ellen Solly, with the brand. Okay, so there is a distinct goods and services. So if there is a distinct goods and services, right, in that case, gross revenue and cost needs to be recognized separately, right? Needs to be recognized separately. The gross revenue and cost needs to be recognized separately, right? So in case of distinct goods and services, you need to see whether the consideration payable to a customer, if the consideration payable to a customer is equal to or less than fair value, is equal to or less than fair value. If the consideration payable to a customer is equal to or less than fair value, then if a consideration payable to a customer is equal to or less than fair value, then the cost needs to be recognized for this amount. So this is B1. This is first point of P, right? But if the consideration payable to a customer is more than the consideration payable to a customer is more than the fair value, if the consideration payable to a customer is more than the fair value, the excess needs to be reduced from the transaction price. Sir, we have not been able to understood this particular concept. So let me explain this again with the help of this example. So there is a television vendor. Okay, so I went to the television vendor and I have bought this television for 1 lakh rupees, and I am also furniture dealer, and this television vendor wants to buy the furniture from me, right? Now, so I bought a television of 1 lakh rupees from this vendor, and he bought furniture from me for 15,000 rupees, which is the fair value. Okay, so he is paying me 15,000 rupees for the furniture, and the market price of such furniture is also 15,000 rupees. So in this particular case, the consideration payable is equal to or less than the fair value. The consideration payable is equal to or less than the fair value. So if I am paying a 15,000 rupees or less than 15,000 rupees for buying a furniture, in that case, whatever I am paying him, so the amount has to be recognized as an expense or a cost, right? For example, if I'm paying 15,000, which is the market price, so of course I need to recognize a cost of rupees 15,000, and revenue has to be recognized full at rupees 1 lakh, right? So I'm talking about television vendor, right? For example, out of 15,000, I have paid him only 12,000 rupees. It means he has given me a discount of 3,000 rupees. And in this case, the cost has to be recognized for 12,000 rupees and the revenue has to be recognized at 1 lakh, right? Sir, what is the second condition? For example, the market value of the such furniture is 15,000 rupees, but I am paying him 20,000 rupees. Tell me, why you will pay him 20,000 rupees? If the market value of the furniture is probably, if you bought this furniture from somewhere else, you of course will end up paying only 15,000 rupees. But since you are purchasing this furniture from your customer, you are paying 20,000 rupees. You are paying 20,000 rupees, right? So why you are paying extra to this customer? Will you pay extra if you bought this furniture from somewhere else who is not your customer? It means you are paying a consideration to your customer which is more than the fair value of what goods or services you are getting in. If this is the case, it means the excess value 20,000 minus 15,000, the excess 5,000 you are paying due to a vendor customer relationship. It means you are giving a discount in the form of excess money which is paid to the customer, right? It means this excess value has to be reduced from the transaction price. So the revenue has to be recognized at 95,000 rupees. So in this particular case, what is the total value of the transaction? 1 lakh rupees is the value of the television, and you are paying 20,000 to the customer. So net 80,000 is there. So whether this has to be recorded in this manner, answer is no. This is not required to be recognized in this manner. In this particular case, the extra 1 lakh rupees which have been paid to the customer. In this particular case, the extra 5,000 rupees has to be reduced from the transaction price, minus 5,000. Okay, and the cost has to be recognized at fair value, which is 15,000, right? And the net, your P&L will be, your profit will be net how much? Your profit will be, of course, 80,000 rupees, right? So this will be the correct answer. This will be the correct answer, right? Have you understood this aspect? So if the consideration payable to a customer is more than the fair value of the goods and services received, in that particular case, the excess needs to be reduced from the transaction price, and to the extent of fair value, cost needs to be recognized, right? So you can understood with this particular example. I hope it is clear to everyone. Sairam, Priya, Namita, I hope it is clear to everyone. Okay. Utkarsh, Mani. I would appreciate your response. Is it clear to everyone? Consideration payable to a customer. Jay has confirmed, Utkarsh has confirmed, Mani has confirmed. Thanks guys for your confirmation. Should I move on? So I have given 5-6 examples, and you have understood if there is a consideration which is payable to a customer from the entity. In that case, you need to see if the consideration is for distinct goods and services, then the cost has to be recognized separately and the revenue has to be recognized on a gross basis. But if it is not for a distinct goods and services, in that case, whatever has been paid to a customer, so that has to be reduced from the transaction price while recognizing a revenue, right? Second, if it is for distinct goods and services, you need to recognize the cost only to the extent of fair value, right? If the entity is paying in addition to the fair value, it means the entity is giving a discount. Of course, that excess needs to be reduced from the transaction price, right? Good, Priya. Thanks for the confirmation. Yeah. So let me move on to my PowerPoint presentation. We will do some case studies from the Institute study material, and then I'll move on to the next concept, right? So in this particular flowchart, if you will see, is the consideration payable to a customer a payment for a distinct goods or services from the customer? Answer is no. There is no distinct goods and services which is given by the customer. So account for the consideration as a reduction of the transaction price. Okay. So remember my example of modification in book sales, right? If the consideration payable to a customer is for the distinct goods and services, if it is yes, in that case, you need to see whether the consideration exceed the fair value of the distinct goods or services that the entity received from the customer. The entity received the furniture worth rupees 15,000, but the entity is paying 20,000. Answer is yes. The consideration exceeds the fair value of the goods and services received from the customer. Then the excess proportion has to be reduced from the transaction price. Okay. And the remaining portion has to be accounted for as a purchase from the customer, right? So 15,000 has to be recognized as a cost. 5,000 has to be reduced from the revenue, reduced from the transaction. Answer is no. The consideration does not exceed the fair value of the goods and services received from the customer. In that case, if answer is no, then whatever you are paying to a customer, please recognize as a cost or an expense, and revenue has to be recognized on a gross basis. Account for the purchase of the goods or service in the same way that the entity accounts for the other purchases from the supplier, right? So simple, you need to recognize a cost or expense. Clear? We have explained this in the Excel file. So Namita is asking, sir, in PepsiCo example of rupees 1 lakh should be treated as cost as PepsiCo enjoy benefit of more sales which was not possible earlier. So Namita, in this particular example which I have taken, so PepsiCo is only giving 1 lakh rupees for the modification in sales, so that the Big Bazaar will be able to keep those bottles, right? So as far as distinct goods and services are concerned, so PepsiCo is not getting any right. PepsiCo is not getting any goods and services, any different goods and services by paying this 1 lakh rupees, of course, right? So it is something which is just PepsiCo is facilitating the Big Bazaar, because PepsiCo knows that I will get a business of rupees 1 crore from Big Bazaar, and of course if I'll pay this customer 1 lakh rupees, this of course my sale will be inflated, right? But it does not gives you any right, of course. Like in the example of Ellen Solly, so Ellen Solly was getting a right in terms of getting a space at the entry gate, and the dedicated space was for the Ellen Solly. Probably in this particular case, while modification of sales, the Big Bazaar could put can put a Pepsi bottle as well as a Coca-Cola or Thumbs Up bottle as well, right? So Big Bazaar can put the other products as well. There is no control of PepsiCo over that, right? So PepsiCo is only facilitating this 1 lakh rupees so that Big Bazaar will buy that product, and Big Bazaar will, of course, Big Bazaar will keep those products, right? So, but there is no any control of PepsiCo. Big Bazaar will put this 1 lakh rupees, this PepsiCo bottle in that particular sales, or other products in that particular sales. Probably there could be a situation where Big Bazaar could put those bottles in the at other places as well, right? So there is no rights which is getting transferred to PepsiCo. Understood? So in this case, it has to be reduced from the transaction price, right? So PepsiCo, and as far as you are saying that he will enjoy more benefit of sales, which was not possible earlier. So of course it is related to the sales, and hence it has to be netted off from the transaction price, right? But in my second example of Ellen Solly is paying 5 lakh rupees, and in lieu of which Ellen Solly is getting a dedicated space, getting a control, getting a right, right? So something which Ellen Solly is getting by paying this 5 lakh. Namita, I hope you understood this. A producer entity sells energy drinks to a retailer, a convenience store, right? Producer also pays retailer a fee to ensure that its product receive prominent placement on store shelves, to attract the customer's eyeballs so that the chances of sale of its products are higher. The fee is negotiated as a part of contract for the sale of energy drinks. In this case, producers should reduce the transaction price for the sale of energy drinks by the amount of slotting fee paid to the retailer. Producer does not receive a goods or service that is distinct in exchange of the payment to the retailer. Again, same example. So the producer is selling an energy drink like PepsiCo, and PepsiCo has paid a retailer some fee, okay, so that their bottles can put on some prominent places, okay, so that the chances of their sale will become higher, right? And this fee, okay, because PepsiCo is paying 1 lakh rupees, and this fee is negotiated as a part of the contract for sale of energy drink, okay. So they are saying, you will pay me 1 crore rupees for this Pepsi bottles, and I'll pay you 1 lakh rupees for modification of the sales, okay, so that you can keep our bottles there. Okay, in this case, the producer should reduce the transaction price. So this 1 lakh rupees has to be netted from 1 crore rupees, because the producer, the PepsiCo, is not getting any goods and services which is distinct in exchange of the payment of the retailer, right? So there is no different goods and services, right? In the second example, if you will see, there is a mobile company, Mobileco, which sell 1,000 phones to retailer for rupees 10 lakh. So there is a mobile company, it is selling 1,000 phone to a retailer for rupees 10 lakh. The contract includes an advertising arrangement that requires Mobileco to pay rupees 1 lakh towards a specific advertising promotion that retailer will provide. For example, there is a Mobileco, for example, let's say Samsung, right? Samsung is selling 1,000 phones to Chroma. There is a Tata Chroma, and this is a contract where this contract includes an advertising arrangement which Chroma will provide to Mobileco, and Mobileco will pay 1 lakh rupees towards that promotion. For example, the Chroma has a big outlet, right? and the Chroma is also putting a hoarding outside the, let's say, LED hoardings outside its outlet, right? So Chroma is saying, so this mobile company Samsung is saying, please put my advertisement outside your store in that LED hoarding, right? And this mobile, this Chroma is saying, okay, I'll do that, but I'll charge 1 lakh rupees, right? So this Samsung mobile company is paying 1 lakh rupees to the Chroma in lieu of this specific advertising promotion, which Chroma will provide, right? Retailer will provide, I mean to say retailer means Chroma, Tata Chroma will provide the advertising on strategically located billboards and in local advertisements. So Tata Chroma will provide the advertisement in newspaper, in their strategically located billboard. For example, outside their store there is a LED billboard and they are providing the advertisement there for Samsung. There are a lot of brands, but Samsung is paying 1 lakh rupees, and that is why they are putting the Samsung advertisement outside their store, right? So this mobile company, which is Samsung, could have elected to engage a third party to provide similar advertising services at a cost of rupees 1 lakh. In this case, mobile company should account for the payment to retailer consistent with the other purchases of advertising services. So in this particular case, why Samsung is paying 1 lakh rupees to Chroma? Chroma is a customer of Samsung. Samsung is paying 1 lakh rupees to Chroma just because of these advertising services, just because of these advertising services, right? The payment from Mobile Co, which is Samsung, to retailer, which is Chroma, is consideration for a distinct service. Of course, this advertising service is a different goods or service, different service provided by retailer and reflects the fair value. The advertising is distinct because the Samsung could have engaged a third party who is not its customer to perform similar services, right? The transaction price is 10 lakh rupees and it is not affected by the payment made by the retailer for the sale of the phones, okay? However, it is to be noted here that if the price paid to retailer for this service is not the fair value of such advertising services, then any excess paid to retailer over the fair value of the said services should be reduced from the transaction price. In that particular case, Samsung, which is a mobile company, which is nothing, it's a mobile co. Samsung will recognize revenue of rupees 10 lakh and cost of rupees 1 lakh, right? For example, if the Samsung will pay 1,50,000 rupees for the advertising services and the fair value is only 1 lakh rupees, in that case, 1 lakh rupees cost needs to be recognized and 50,000 should be reduced from the transaction price of rupees 10 lakh. So any excess from the fair value of the goods and services received from the customer, so that excess needs to be reduced from the transaction price, and to the extent of fair value, the cost has to be recognized. I hope it is clear to everyone, guys. Namita, I hope it is clear to you. Friends, please let me know if it is clear to all of you. Please let me know. Let's do illustration number 52 from Institute Study Material. An entity that manufactures consumer goods enters into a 1-year contract to sell goods to a customer that is a large global chain of retail stores. The customer commits to buy at least rupees 15 crore of products during the year. So customer is committing for 15 crore of the 15 crore of products. The contract also requires the entity to make a non-refundable payment of rupees 1.5 crore to the customer at the inception of the contract. So customer is paying 15 crores to this entity, and this entity is also paying a non-refundable payment of 1.5 crore to the customer. So there is a consideration payable to a customer for 1.5 crore at the inception of the contract. The 1.5 crore payment will compensate the customer for the changes it needs to make to its shelving to accommodate the entity's products. The entity does not obtain control of any rights to the customer shelves. Determine the transaction price. So customer is committing a sale of 15 crore rupees, and this entity is not getting any revenue, and this entity is paying upfront 1.5 crore to the customer. Why? First of all, tell me why. Because of course, this entity is expecting a huge sales from this customer. Okay. And this entity is paying 1.5 crore to facilitate the customer to make a space to modify itself so that this entity can keep the product of this entity in their shelves, and the entity will be able to sell 15 crore worth of products during the year, right? But the amount which is payable by this particular entity does not give any right to this entity over the customer sales. Okay. So they have paid that, and it is at the discretion of the customer. Whatever the customer wants to do, he will do that, right? So probably the customer will not keep the goods there. The customer will keep the goods at other places also, right? So determine the transaction price. Tell me what is the transaction price in this case. So in this particular case, if you will see, the entity consider the requirement. First of all, what is your answer? The answer is, since there is no distinct goods and services, so 1.5 crore has to be reduced from 15 crore. So my revenue has to be recognized at 15 minus 1.5. So revenue has to be recognized at net basis 13.5, right? So the entity consider the requirement in para 72 of Ind AS 115 and concludes that the payment to the customer is not in exchange of a distinct goods or services that transfer to the entity. Now, sir, do we need to write this para number? Answer is no. Okay. You can write that as per the requirement of Ind AS 115, the entity concludes that in this example or in this case study, the entity concludes that the customer, the payment to the customer is not in exchange of any distinct goods and services that transfers to the entity. Why? This is because the entity does not obtain control of any rights to the customer sales, right? Like in the case of Ellen Solly, the entity is getting a control. Ellen Solly is getting a control over a dedicated space of Superstop. Consequently, the entity determined that in accordance with Ind AS 115, not para number, Ind AS 115, the 1.5 crore payment is considered as a reduction in the transaction price, right? The entity applies the requirement in as per Ind AS 115 and concludes that the consideration payable is accounted for as a reduction in transaction price when the entity recognizes revenue for the transfer of goods. Consequently, as the entity transfer the goods to the customer, the entity reduces the transaction price for each goods by 10%. For example, sir, what does it mean? So the entity will sell, or let's say this customer will pay 15 crore over a period of 12 months, right? And we understood that this has to be reduced as a transaction price, reduction in transaction price. So for 15 crore sale, I have paid 1.5. It means I have given 10% discount, or let's say I have given 10% of amount, as I can say that as a discount to the customer, as a refund to the customer. So how can I recognize this money? Can I recognize this 1.5 crore upfront as a cost? Although I'll recognize the revenue, I'll receive the money from the customer over a period of 12 months, but I'm paying 1.5 crore upfront. So going by the matching principle, can you recognize the cost as 1.5 crore upfront and recognize the revenue for a period of 12 months? Answer is no. Why? This cost is also associated with the revenue, entire revenue for a year. It means this cost is also scattered over a period of 12 months. So every month, whatever revenue is recognized by this entity, this revenue will be reduced by 10%, right? This revenue will be reduced by 10%. For example, in the first year, in the first quarter, for example, the entity has recognized a revenue of 5 crore. So in this case, 50 lakh has to be reduced from the transaction price. In the next quarter, the entity has recognized a revenue of 2 crores. So 20 lakh has to be reduced from the transaction price of 2 lakh, so 2 crore. Okay. In the third quarter, the entity has again recognized a revenue of 5 crore. Again, the revenue has to be reduced by the 10%, which is 50 lakh rupees in the third quarter. So 5, 2, 7, 5, 12. In the last quarter, the entity has recognized a revenue of 3 crores. So in that case, 30 lakh has to be reduced from this 3 crore as a transaction price. And if you total it, so it will become 1.5 crore. Okay. Understood? Is it clear to everyone? Guys, is it clear to everyone? Tell me if it is clear to everyone. Yes or no? So let me take you through one more example. Entity A enters into a contract with a customer for the exclusive supply of pen for a 3-year period. So there is entity A and is entered into a contract with a customer. For example, Asian Paints entered into a contract with a customer for exclusive supply of paint for a 3-year period. So they are getting a contract for 3 years. Entity A, the vendor, is making a payment of 50,000 rupees, currency unit, I mean to say 50,000 rupees, upfront payment. So the entity is paying upfront, which the customer will use to customize its paint sprayers for entity A's product. The entity A is supplying a paint to the customer, and for using this paint, they need a sprayer. Okay, this customer will need a sprayer, and this entity is paying 50,000 rupees to buy a paint sprayer, right? Or for customizing the paint sprayer so that this entity's product can be used. So first of all, you need to see whether for this 50,000 rupees, the entity is buying some goods and services from the customer. We need to see that. In the third line, in the third para, it is written that the entity, the vendor, determine that the upfront payment is not a different goods or service. It is not a distinct goods and services. So very clear. If it is not a distinct goods and services, so this 50,000 needs to be accounted for as a reduction in the transaction, as a reduction in the transaction price, right? And the entity A estimate that 10 lakh rupees in sales with the customer over the 3-year period. Okay, and the entity is expecting 10 lakh rupees of sales with the customer over a 3-year period, and this 50,000 has been paid upfront. So tell me whether upfront cost needs to be recognized for 50,000 rupees, or it has to be allocated to the revenue pro rata over a 3-year period. So the upfront payment is deferred and recognized as a reduction in revenue in proportion to the estimated sales over the contract. Okay, so this 50,000, going by the matching principle, this 50,000 is not going to be recognized upfront. Rather, this 50,000 has to be allocated pro rata in proportion to the estimated sales over a contract period, which is 3-year period. Okay, which is 3-year period. So in this particular case, for example, instead of calling it as a first quarter or let's say second quarter, I will call it as a first year or second year. In the first year, for example, there is a 1 lakh rupees of sales. Okay, so entity A continues to estimate 1 million in sales. So what is the estimation? 10 lakh rupees total sales, and the entity A has made a sales of rupees 1 lakh in the first quarter or let's say first year. So how much sales has been done? The estimated sales was 10 lakh rupees. Entity has made a sale of 1 lakh rupees. So 1 lakh divided by 10 lakh, it comes out at 10%. So in the first quarter, the entity has made a sale of 10% of the estimated sales. Now, how much revenue needs to be reduced by this upfront payment? So what is the 10% of 50,000? Is 5,000. So in this particular case, 1 lakh minus 5,000. So revenue has to be recognized as 95,000 in the first quarter, right? So entity A recognized revenue of 95,000. So 1 lakh actual sales minus 5,000 portion of consideration paid to the customer. Now, how much consideration paid to the customer is required to be deferred? 45,000 is required to be deferred, and it has to be adjusted in transaction price over a 3-year period in the proportion of remaining sales. In second quarter, the sale was 1,25,000. And entity A updated estimates of total sales over the contract to 15 lakh. Now, in the second quarter, there was some development, and now entity is estimating, yes, I will be able to sell 15 lakh over the contract period, not 10 lakh, it is 15 lakh. So in this case, till quarter 2, how much sales has been made? Q1 1 lakh rupees, Q2 1,25,000 rupees. So total sales till date, how much total sales till date is there? 1 plus 1.25, 2,25,000. And what is the estimated sales? What is the total estimate over the contract period? 15 lakh. So 2,25,000 divided by 15 lakh gives you 15%. It means I have to reduce 15% of the upfront payment from the transaction. So 15% of 50,000 will give you 7,500. And how much already transaction price, how much upfront payment has been reduced from the transaction price? Till now, it should be 7,500. But in Q1, we have already reduced 5,000. So 2,500 needs to be recognized in Q2. So you have to see on a year-to-date basis or on a life-till-date basis, right? So entity A will recognize revenue of 1,22,500 for second quarter, which is 1,25,000 minus 2,500. So 125 minus 2,500 portion of consideration paid to the customer, right? I hope it is clear to everyone, guys. So what I have done, first of all, if it is not for distinct goods and services, then what you are required to do, you have to reduce the transaction price, you have to reduce the revenue from the consideration payable to a customer. Although you are paying it upfront, but the cost is not going to be, or revenue is not going to be reduced upfront, right? Because probably there will not be any revenue. Okay. So first of all, you are paying to the customer, right? The customer is not paying you, you are paying to the customer, and the customer will pay you later on, right? So this upfront payment has to be scattered and needs to be reduced from the transaction price in the proportion of the revenue or the sales, right? For example, in Q1, so 10% sale has been done. So 10% upfront payment has to be reduced from the revenue. In Q2, again, we have to see the updated estimates, and 15% of the total sales has been done. So what we have done till Q2, we have just reduced 15% of the upfront payment from the revenue, okay, on the life till date basis. I hope it is clear to everyone, guys. He is asking, sir, entity will recognize revenue netting off. Will that be the purchases for customer in customer books? Jay is asking, sir, can example in PPT be solved like illustration 52? Example in PPT. Yes, Jay, even that can be solved like, either way you can solve this example. For example, you can write down that as per the provision of Ind AS 115, entity is not getting any distinct goods and services from the consideration payable to a customer. Why? Because the entity is not getting any control over the goods and services, which is the entity is not getting any control of the goods and services by paying the consideration to a customer, and hence this consideration needs to be netted off from the transaction price of rupees 10 lakh, right, which is an estimated transaction price over a 3-year period, right? And such upfront fee payment, or let's say such upfront payment, consideration payable to a customer, has to be scattered over a contract period in proportion to the sales, made by the entity, right? And after that, if the question asks you what is the revenue which is going to be recognized in Q1 or Q2, you have to show these kind of calculations, right? If the question will ask you what is the transaction price in Q1, what is the transaction price in Q2, so you need to solve this. So you need to solve in this particular manner, right? So Vidula saying is yes, sir, it is very much clear. So I hope it is clear to everyone. I hope it is clear to everyone, guys. Now coming to the non-refundable upfront fees. So guys, you must have gone to the gym, yoga classes, okay? So when you go to the gym or when you join the yoga classes, so probably you are paying some upfront fee as a membership fee, right? So if an entity is paying, so if a customer is paying a membership fee, okay, so once you pay the membership fee, or when you go to any hospitals, you know, so nowadays when you go to the Fortis or Max Hospital, so if you are a first time patient, so they will charge 100 rupees for that registration, right? Now the question arises, in case of a non-refundable upfront fee payment, which is non-refundable, right? So whether the revenue has to be recognized by the entity at the time of receipt of money from the customer, or the revenue has to be recognized when the goods and services will be transferred by the entity. For example, I went to the yoga classes and I pay a membership fee of rupees 1000, which is joining fee, and I'll pay 2000 rupees every month, right? So I'll pay 24,000 rupees in a year and 1000 rupees a joining fee. So whether the entity will be able to recognize revenue for this 1000 rupees upfront, the answer is, in that case, you need to see whether this 1000 rupees is for a performance, for a separate performance obligation. I mean to say, for this 1000 rupees, whether this entity will deliver any goods and services. So in this particular case, when I am paying 1000 rupees membership fee to this yoga classes, the entity is not giving me any performance obligation at the time of receipt of 1000 rupees of joining fee. So it means this is not a separate performance obligation. When the customer will come, customer will pay the money over a period of 1 year, because this membership fee is for 1 year and the customer can come at any point of time, right? So when I'll deliver the goods and services for over a period of 1 year, in that case, I can say that I have delivered goods and services to the customer. And since this joining fee or non-refundable upfront fee is not for a separate performance obligation, and hence it will not be recognized as a revenue at the time of receipt of joining fee, right? It has to be scattered over a period of 1 year, and it has to be recognized as a revenue when the services or the performance obligation are satisfied over a period of time, right? So entities are required to evaluate whether non-refundable upfront fee relate to the transfer of a future goods or services. And if it is relating to the transfer of future goods and services, in that case, the revenue is not required to be recognized upfront, right? So let's see illustration number 28. Customer buy a new data connection from the telecom entity. It pays one-time registration and activation fee at the time of purchase of new connection. So the customer has bought a data connection from the entity and it pays a one-time registration and activation fee at the time of purchase of new connection, right? The customer will be charged based on the usage of the data services of the connection on monthly basis. So it pays a one-time registration and activation fee, and when this SIM card get activated, then only the customer can use the services, right? And for that, the customer will be charged on a monthly basis. Are the performance obligation under the contract distinct? Whether this one-time registration and activation fee and this particular data services, whether there are two different performance obligation or there is a single performance obligation. So by selling a new connection, the entity promises to supply data services to a customer. While taking a membership fee, I am promising that I'll give you the yoga classes, right? You can come to me, and when you pay me this 1 month fees, either in advance or at the time of completion of 1 month, so of course I'll give you yoga classes. So by taking a membership fee, by selling a new connection, the entity promises to supply data services, or the entity promises to supply yoga classes to the customer. Customer will not be able to benefit from just buying a data card and data services from third party, right? So the customer cannot, in my example, the customer cannot pay me membership fee and can take a yoga classes from other vendor, right? So if the customer will come to me, then only he will get benefited by pay of this particular membership fee. The activity of registering and activating connection is not a service to a customer, and therefore does not represent satisfaction of performance obligation, right? By having a membership fee, I'm not providing any benefit to the customer, right? And you know what was the intent of this standard? The intent of this standard was the customer should be able to get the benefit from the use of goods or services. So in this particular example, the entity's obligation is to provide data service, and hence activation is not a separate performance obligation. And this one-time registration and activation fee has to be recognized in consortium with the data services which is paid by the which is given by the entity, right? Understood? Is it clear to everyone, guys? Is it clear to everyone? It's 8:30 now. Let's have a 10 minutes break, okay? And we will start at 8:40, right? Let's have a 10 minutes break. And in the meantime, if you have any query, just let me know. And after the break, I'll take the query. So we'll start at 8:41, right? So Jay is asking, sir, can we use 50,000 divided by 10 lakh as a discount for this example? So Jay, you cannot use 50,000 divided by 10 lakh. It will hold good if the estimated sales will be, of course, 10 lakh rupees over the contract period of 3 years. But if the sales will get updated, for example, today we are expecting 10 lakh rupees of sales, but tomorrow it will become 15 lakh. So whenever the estimation got updated, you need to update your percentage which is given as a discount as well, right? So you need to update the percentage also. Okay, so this upfront payment or consideration payable to a customer, if it is not for distinct goods and services, it has to be reduced from the transaction price in proportion to the sales or in proportion to the revenue which has been incurred with the customer, right? So if the revenue is getting updated, so you need to update this particular discount as well, right? Like in this example of 50,000 in the first quarter, it was 50,000 divided by 10 lakh, right? So the sale was like 1 lakh out of 10 lakh. So 10% was the sale. So 10% was the discount. Okay, you can do in that way also, right? But in the next quarter, it become 15 lakh. So we have calculated how much is the estimated sales. So the estimated sales was 2,25,000 divided by 15 lakh, which comes out at 15%. So you need to recognize a discount of 15% out of this upfront payment. You need to reduce the transaction price by 15% of the upfront payment, which is 7,500, right? Out of the total 2,25,000. I hope it is clear to everyone. So guys, we have spent a good time on the consideration payable to a customer. Apart from in the beginning, we have spent around 15 minutes on this entire revision of the first 3 steps, right? So now I hope my PPT is visible to everyone. I hope my PPT is visible to everyone. Can any of you please confirm that? And I hope my voice is clear and loud. Yeah, thanks for the confirmation. Now the time has come to the step 4, and let me tell you, the step 4 and step 5 is a very smaller kind of steps, right? Very smallest steps. The larger steps was step 1, 2, and 3. And coming to the step 4, so once you have identified that yes, it is a contract with the customer, you have already identified that yes, these are the sort of performance obligations. You have also identified transaction price by factoring the variable consideration, significant financing component, which is the time value of money, non-cash consideration if there is any, and consideration payable to a customer if there is any, right? So after considering these 4 aspects, you have finalized your transaction price. Now the time has come. If you have identified, let's say 3 performance obligation, P1, P2, P3, right? So you need to allocate the entire transaction price into the multiple performance obligation. And my dear students, if you need to understand this particular standard well in advance or well in detail, so please refer the part 1 of this Ind AS 115 class, wherein I have given you a helicopter view of this particular standard, and wherein with the help of the lemon example, I have explained the 5 steps, right from the identification of the contract to the revenue recognition. So now the time has come into the step 4. We have different performance obligation. We have a transaction price. Now this transaction price needs to be allocated to the different performance obligation. Why? So that whenever each performance obligation is satisfied, we will be able to recognize revenue. And if we have to recognize revenue, we need to have an amount for that, right? We need to have an amount for that. Clear? So now the question arises, sir, how to allocate this transaction price into the multiple performance obligation? How to allocate the transaction price, right? So standard says that first of all, while calculating or while allocating the transaction price to the performance obligation, you need to allocate the transaction price to the various performance obligation on the basis of their standalone selling prices. For example, in my helicopter view example, the entity has 4 performance obligation. 1, sale of air condition unit. 2nd, sale of stabilizer. 3rd, installation service. Fourth, maintenance service, right? So first of all, I need to estimate the standalone selling price of these four performance obligations. What is the standalone selling price if the entity is only selling this air condition? What is the sale price of this air condition, right? What is the sale price of this air condition into the market? What is the sale price of stabilizer? What is the price for providing an installation service? What is the price for maintenance service? So these are the four performance obligation, and the most important and the most prominent and the most acceptable value for allocation of transaction price is allocate the transaction price on the basis of standalone selling price of each of the performance obligation. Okay, sir, if the standalone selling price of these performance obligation are not identifiable, for example, we don't have the fair value of these performance obligation because probably the entities are not selling on a separate basis, for example, okay, or the entity is not able to estimate the fair value of this performance obligation. In that case, what to do? In that case, standard says that, okay, if you don't have observable inputs, if you don't have the observable inputs, if you don't have the standalone selling price of performance obligation, in that case, you need to estimate those prices. Sir, how to estimate those prices? So the first priority is you have to go to the fair value or standalone selling price of each of the performance obligation. And if it is not there, you need to estimate the standalone selling price of the performance obligation. And for estimation, there are three approaches which is given in the standard. One is AMMA approach. Sir, what is this AMMA approach? Adjusted market assessment approach. Okay. The second one is expected cost plus margin approach. The third one is residual approach, right? So you need to apply three approaches for identification of standalone selling price of the performance obligation. So let me take you through the Excel file so that you will be able to understand this particular thing in detail. I hope my screen is visible to everyone as far as Excel file is concerned. I hope it is visible to everyone. Just a minute, I'm resharing my Excel file because I'm facing some problem in the Excel file. Yeah, it is fine. Step number 4. What is the step 4? Step 4 is allocation of transaction price. Allocation of transaction price, right? So standard says that the transaction price, I would request each one of you to please write down these notes. Transaction price needs to be allocated on the basis of standalone selling price of the performance obligation, right? The performance obligation. On the standalone selling price of the performance obligation. Clear? For example, the example number A, the transaction price for a bundle of goods and services which is A, B, C, D are rupees 1 lakh. These are distinct goods and services and separately identifiable in the contract and are separate performance obligation, right? And a separate performance obligation. These are distinct goods and services and separately identifiable in the contract and are separate performance obligation, right? The standalone are separate performance obligation. So determine the transaction price for each performance obligation, right? Obligation. The standalone selling price are given as follows. Performance obligation, PO, SSP, standalone selling price, SSP. So let's say product A, B, C, D. Okay. 50,000. Let's say 25,000, 25,000, 25,000. Right. These are the standalone selling prices. Now, friends, if you look at the standalone selling price of all these 4 products, so the total comes out at 1,25,000. Now, what is the transaction price? Now we need to see how to allocate the transaction price. Allocate the transaction price. For example, this is a question which came in the which came in the examination, and how to write the answer of this particular question. So you need to write, since these are 4 separate performance obligation and the transaction price is rupees 1 lakh, we need to allocate this 1 lakh rupees over the standalone selling price of these 4 performance obligation, right? For having this standalone selling price of the performance obligation, first we need to see the fair value, or let's say observable inputs, so that we can have the standalone selling price of these performance obligation. Although this standalone selling price of these performance obligation is given in the question, right? Now how to allocate? So I need to allocate the transaction price of rupees 1 lakh in the proportion of the standalone selling price of these performance obligation. So how to allocate this? 1 lakh rupees, or you can say that total value of this 4 separate performance obligation aggregating comes out at 1,25,000. But we are getting this entire bundle, entire group at 1 lakh rupees. It means by having a bulk deal, by having a group deal, I am getting a discount of rupees 25,000. I can say that. Okay. It means I need to allocate this 25,000 discount to all these performance obligation. Okay. So how can I do that? So I need to allocate this 1 lakh rupees over these performance obligation in the ratio of their fair values, or in the ratio of their standalone selling price. So what is the formula? 1 lakh multiply by the standalone selling price of this particular performance obligation, divide by the total fair values or total standalone selling price of these performance obligations. It comes out at 40,000. Again, 1 lakh multiply by individual standalone selling price divided by the total standalone selling price. Again, 1 lakh multiply by individual standalone selling price divided by the total standalone selling price. Again, 1 lakh multiply by the individual standalone selling price divided by the total standalone selling price. So this total comes out at 1 lakh, right? And if you see, you will find that this 25,000 rupees discount has also been allocated in this particular bundle. Do we need to calculate this discount, or do we need to put any accounting for this discount? Answer is no. Your transaction price is 1 lakh rupees, and of course revenue has to be recognized at net of the discount only, right? You have seen that revenue has to be recognized with the net of discount, right? So in this case, how this transaction price has been allocated? The transaction price has been allocated on the basis of standalone selling price of the performance obligations, right? So please write down standalone selling price will be the fair value of the performance obligations, which is the observable inputs, which is the observable inputs, okay, used for determining the fair value. Okay. So it is nothing, it's a market value, as simple as that. For example, what is the value of air condition? What is the value of installation? What is the value of stabilizer? What is the value of maintenance, right? So it is nothing, it's a market value. Okay. It's a market value, it's a fair value. So that is the standalone selling price. Now, if the standalone selling price is not available, then standard says that if standalone selling price is not available, then use the estimated price, for determining standalone selling price. If standalone selling price is not available, then use the estimated price for determining standalone selling price. And for determining the estimated price, what are the methods? What are the methods for determining estimated selling price? The methods are estimated price, how to calculate the estimated price, and the method is nothing, it's a three method, it's a three approach, right? What are those three approaches? Approach number one. Approach number one, adjusted market assessment approach. Okay. Approach number two, cost plus margin approach. Approach number three, residual approach. Now let's discuss these approach one by one. Adjusted market assessment approach. What is meant by adjusted market assessment approach? Adjusted market assessment approach is nothing, it's a competitors. It's a competitor's selling price. It's a competitor's selling price. Okay. Adjusted with entities, cost and margin. Adjusted with entities, cost and margin. What does it mean? For example, there are three performance obligation A, B, C. I'm not able to identify what is the market price of this product A. This product A is not sellable in India. This product A is sellable in American market, right? So for example, in American market, this product is sold at 1 lakh rupees, right? So what will be the fair value and what will be the estimated price in India if my competitor in USA is selling this product at 1 lakh rupees? 1 lakh rupees is the fair value. So of course there is a cost in India as well as I'm expecting X% margin. Okay. So if I will adjust my cost and margin from that particular 1 lakh rupees of fair value, okay, so it will give me a price as per the adjusted market assessment approach. For example, taking this product from US to India will cost around 1 lakh rupees. And that product is selling in US market at 5 lakh rupees. So what could be my fair value? It could be 6 lakh rupees, right? So adjusted market assessment approach means the price on which my competitor is selling this goods and services adjusted with the entities cost and margin, right? It will give you adjusted market assessment approach. So guys, don't bother about that. If any approach which is required to be used, probably it will be given in the question in your examination, right? So generally question will not ask about this adjusted market assessment approach. This cost plus margin approach. So there are three performance obligation A, B, C, but you are not aware about the standalone selling price because the market values are not available. Okay. But of course you are able to identify if I have to provide an installation service, what is my cost? What is my cost? For example, I need to pay 500 rupees to the technician who will go, or the mechanic who will go and install the air conditioner at the customer premises. If I have to pay him 500 rupees, of course, I need to charge something extra from the customer. For example, I have to pay him 500 rupees. And normally in my business, I'll keep a margin of 15%. So in this case, 500 plus 15% of 500, which is 75 rupees. So 575 rupees will be the standalone selling price as per the cost plus margin approach. Have you got it? So cost plus margin approach means cost of the goods and services, services adjusted with the expected margin. Okay. Like in this example, 500 is my cost and my expected margin is 15%. So my standalone selling price H per cost plus margin approach is 575, right? What is the residual approach? What is the residual approach? For example, just to make you understand the residual approach. For example, there are three performance obligations, A, B, and C, right? The total value, the total standalone selling price, let's say the standalone selling price of B and C is available. For B it is 10,000, for C it is 15,000, and it is written in the question that the total fair value, or let's say the total fair value of the standalone selling price of entire contract, including A, B, and C, is rupees 30,000, right? So going by the residual approach, if I'm aware about B and C, so the price of the B and C is how much? 25,000. So going by the residual approach, the remaining will be, so this total should be 30,000. Am I right? The total should be 30,000 because the value of the entire contract is given as 35,000. So what will be the value of A? What will be the value of A? The total fair value of the entire contract is 30,000. Standalone selling price of B and C is given. Going by the residual approach, what will be the value of A? It is total value minus B minus C. It is 5,000. So it will be 5,000, right? So residual approach, going by the residual approach, what is my standalone selling price? My standalone selling price is the total value of the contract minus the standalone selling price which is available to the company, and the remaining value will be the going by the residual approach, the remaining value will be the standalone selling price for that particular product. Okay, so this is the residual approach. Okay, so guys, I hope you are able to understand this. Jay is asking, sir, what is the observable inputs means? Observable inputs means market inputs. Okay, so you need to, first of all, you need to see what is the market price, at what value the entity is selling these goods and services on a standalone basis. So you need to see that, right? Is it clear to everyone? Guys, is it clear to everyone? Clear? Yes? Yes, no? Okay, so let's discuss a case study or an example. Then we will come to the next concept of allocation of transaction price. And I hope my PPT is visible to everyone, guys. Coming to the allocation of transaction price example, the price mentioned in the purchase order is rupees 50 lakh for delivering a machine, right? For delivering a machine. This 50 lakhs should be allocated to the various performance obligation identified earlier on the basis of its standalone selling price. What is the total transaction price? The total transaction price is 50 lakhs. And this 50 lakh has to be allocated on the various performance obligation identified earlier on the basis of its standalone selling price. The standalone selling price at which the machinery is sold in the market is 48 lakhs. So the observable inputs for this machinery is given. And what is the standalone selling price of machine? The standalone selling price of machine is 48 lakhs. The observable price for delivery, service, and packaging is not available. Okay. So there are two more performance obligations. In this particular question, there are three performance obligations. One is machine, second one is packaging, third one is delivery service, right? So the observable price for packaging and delivery service is not available. The cost related information is as follows, but the entity knows how much I need to invest, how much I need to incur as a cost in terms of packaging. It is 83,333. The entity knows that if I need to deliver this product to the customer, deliver this machine to the customer, I would end up incurring a cost of 4,34,783, right? And every entity knows the estimated cost. Every entity knows the cost, right? For example, if you're not aware about the delivery cost, for example, you can engage some vendors and you can ask for the quotation. If I need to deliver this 100 kg machine from Delhi to Bhilwara, then what will be the cost, right? So packaging cost, again, you can estimate or you can just check from the different vendors, right? So as far as this packaging cost or delivery service is available, so observable inputs are not available in the market, but the cost is available, that what cost I'll incur, for example, what cost I will be able to incur here. So which is given in the question. And normally the entity estimate, normally the entity will keep a margin of 20% on packaging and 15% on delivery service. So going by the cost plus margin approach, we have identified the standalone selling price of packaging performance obligation and delivery service performance obligation. Now the total transaction price is 50 lakhs. What is my total transaction price? My total transaction price is 50 lakhs. Now what is my standalone selling price? My standalone selling price sale of machine is 48 lakhs. For delivery service it is 1 lakh. For packaging it is 5 lakh. So I have just written reverse. So delivery service come here, delivery, and packaging will come here. Okay, packaging, right? So for packaging it is 1 lakh, for delivery it is 5 lakh, and the total value of the contract is 54 lakh. Total standalone selling price of the contract is 54 lakh. But the transaction price is 50 lakh. It means there is a discount element on account of taking this entire contract as one contract. There is a discount element. So how to allocate the transaction price? Of course, first we have identified the standalone selling price of packaging and delivery performance obligation. Once the standalone selling price has been identified, then the transaction price needs to be allocated to this performance obligation in the ratio of 48:1:5, right? So in the ratio of the standalone selling price of the product. So how to calculate that? 50 lakh multiply by 48 lakh, which is individual standalone selling price, divide by 54 lakh, which is the total standalone selling price. 50 lakh multiply by 1 lakh, divide by 54 lakh. 50 lakh multiply by 5 lakh, divide by 54 lakh. So it will comes out at 44, 44, 444 in the first case, 92, 593 in the second case, 462, 963 in the third case, right? So this is how we have estimated the standalone selling price, and we have calculated estimated the standalone selling price, and we have identified or calculated the transaction price to be allocated to each performance obligation, right? Guys, I hope you have cleared so far. Guys, I hope you are able to understand whatever I have told you so far. Allocation transaction price. So the transaction price needs to be allocated to each performance obligation, first of all on the basis of the standalone selling price in the ratio of their standalone selling price. How to identify standalone selling price? On the basis of fair value, which is market value. If that is not available, you need to go by the estimated price. How to calculate the estimated price? First, you need to apply the adjusted market assessment approach. If that is not available, of course, you need to apply cost plus margin approach. And the third one is residual approach, right? So I have just discussed an example of cost plus margin approach, right? Now we will take an example from the Institute study material. Let me know if you have any queries so far. An entity enters into a contract with a customer to sell products A, B, and C in exchange for rupees 10,000, right? So what is the total value of the consideration? It is 10,000, right? And what are the performance obligation? A, B, and C. The entity will satisfy the performance obligation for each of the product at different point in time, right? So of course the point in time is different and there are different performance obligation. So we need to recognize revenue for this A, B, C on a different at a different point of time, and hence we require the price, the amount on which the revenue has to be recognized for this A, B, and C. And of course the total should be 10,000. The entity regularly sells product A separately, and therefore the standalone selling price is directly observed. So the entity is selling this entire ABC into the packaging as a package, and the entity is also selling this product A on a standalone basis, and hence the price of product A is available, right? The standalone selling price of product B and C are not directly observable. So this price or standalone selling price of product B and C are not identifiable because the market value is not directly identifiable, right? Because the standalone selling price for product B and C are not directly observable, the entity must estimate them. The entity has to go to the estimated price method, and the entity needs to apply adjusted market assessment approach or cost plus margin approach or residual approach. Sir, in this particular case, for example, there are 3 performance obligations, and for product A, observable inputs are available, market price is available, so that was the best one. We got that. But for the remaining 2 performance obligation, either we need to apply a single approach or we can apply a different approaches for the different performance obligation. You can apply the different approaches for different performance obligation. So you can apply, right? If you want to apply a single approach, you can apply a single approach. If you want to apply different approach, you can apply different approach. But you need to apply that approach which will be more suited to that particular performance obligation. For example, if for a particular performance obligation cost is available, and you are also aware about the expected margin. So in that performance obligation, cost plus margin is the most appropriate method. But for one performance obligation, cost is not available. And of course, if the cost is not available, but of course, you are aware that at what price my competitor is selling into a different market, this particular product. So in that case, you can go for the adjusted market assessment approach as well, right? So to estimate the standalone selling price, the entity uses the adjusted market assessment approach for product B. For product B, the entity is estimating the price using the adjusted market assessment approach, okay? And for product C, the entity is using the cost plus margin approach. In making those estimates, the entity maximizes the use of observable input. The entity estimates the standalone selling price, and using both the approaches, the standalone selling prices are also given. For product A, it is 5,000. The market value is available. For product B, it is estimated at 2,500 using AMMA approach. For product C, it is estimated at 7,500 using the expected cost plus margin approach. Determine the transaction price allocated to each product. So how to determine the transaction price allocated to each product? So what is the total transaction price? The transaction price is 10,000. And this 10,000 needs to be allocated on the basis of fair value of 50:25:75 on the basis of in the ratio of standalone selling price of different performance obligation. So 10,000 multiplied by 5,000 divided by 15,000. So how to allocate? 10,000 multiplied by 5,000 divided by 15,000. 10,000 multiplied by 25,000 divided by 15,000. Okay. So transaction price multiplied by individual standalone selling price divided by the total standalone selling price. What is the formula? What is the formula? Transaction price multiplied by standalone selling price of performance obligation divided by standalone selling price of total performance obligation, right? Of total performance obligation. So this is the formula. By this, you have allocated the transaction price. For product A, it is 3,300. For product B, it's 1,700, and for product C, it is 5,000. Although it was 5,000, 2,500, and 7,500, the standalone selling price was. So it means the total value was 15,000 and the transaction price is 10,000. It means the 5,000 is an element of discount, which is also allocated to all these performance obligation. I hope it is clear to everyone, guys. I hope it is clear to everyone. Sainam, Thota, Namita, Jay, Shruti, Utkarsh, Mani, Vidula. I hope it is clear to everyone. Should I move forward? Should I move forward? Great. Thanks, Mani. Thanks, Utkarsh. Yeah, thank you, guys. So let's again move to my Excel file, and I'll give you 2 more concepts on this allocation of transaction price. And for that, So far we have understood how to allocate the transaction price. We need to allocate the transaction price on the basis of ratio of standalone selling price of these performance obligation. First of all, standalone selling price is the fair value, which is a market price of these individual goods and services. If it is not available, you need to go for the estimated price approach. And for estimated price approach, you need to apply three methods. One is adjusted market assessment approach, cost plus margin approach, or residual approach. I have already told you one by one all these approaches. Now, guys, there are two important things which needs to be taken into consideration for allocating a transaction price. The one concept, important concept. Please write down this as an important concept. The first important concept is allocation of discount to the performance obligation. Performance obligation. Then the second one is allocation of variable consideration. Allocation of variable consideration, right? Allocation of discount and allocation of variable consideration. To the performance obligation while allocating the transaction price. While allocating the transaction price. First of all, we'll discuss how to allocate the discount to the performance obligation while allocation of the transaction price, right? We'll discuss that. So friends, please write down the discount needs to be allocated to the discount needs to be allocated to the performance obligations, to the performance obligation in the smallest bucket first, then to the entire contract. Okay, then to the entire contract. Okay, so the discount needs to be allocated to the performance obligation in the smallest bucket first, then to the entire contract, right? And if you are using a residual approach, and if you are following a residual approach, in that case you are required to first apply the discount, okay, in the transaction price. You are required to first apply the discount in the standalone selling price of the remaining performance obligation while calculating the transaction price, while calculating the standalone selling price of the remaining performance obligation as per the residual approach. For example, there are A, B, C, three performance obligations are. So for A and B, the transaction price is, the standalone selling price is identifiable for A and B, right? The transaction price is identifiable. The standalone selling price is identifiable. So if you will apply the residual approach without taking the discount into the consideration, in that case, probably you will provide the entire discount to the last performance obligation, right? By the residual approach, the remaining performance obligation. So if you are applying a residual approach for identifying a standalone selling price, first you need to apply the discount to the other performance obligation. Then you need to calculate the residual value by the residual approach, right? So I'll explain that part also, right? First of all, the discount needs to be allocated to the performance obligation in the smallest bucket first, then to the entire contract. So, sir, what is this? So let me explain you. There are three performance obligations, right? A, B, and C. There are three performance obligations. The value of the performance obligation A is 10,000. For B, it is, let's say, it is 8,000. And for C, it is like 2,000, right? There are three performance obligations. These are the standalone selling price which is available. Standalone selling price, right? The transaction price of contract ABC, like this is the entire contract, is rupees 15,000, right? Is rupees 15,000. Okay, the transaction price is rupees 15,000. The entity is also selling B and C together, at rupees 8,000, right? The entity is also selling the B and C together at rupees 8,000, right? So determine the allocated transaction price of A, B, and C so that the revenue can be recognized for these performance obligations. I hope this question is clear to everyone. I hope so. This question is clear to everyone. Yeah. My dear friends, first of all, if you will see this particular example, so what is the smallest bucket? What is the smallest bundle? The smallest bundle is B and C. Okay. If you see this particular example, the standalone selling price of B and C is 8 plus 2, which is 20,000. What is the total standalone selling price? The total standalone selling price is 20,000, right? And the contract price, the transaction price is 15,000. But so what does it mean? Total contract value is 20,000. The total contract value, I mean to say the total standalone selling price is 20,000 and the transaction price is 15,000. It means the element of discount is 5,000, right? The element of discount is 5,000, right? So it means the 5,000 is the discount over this A, B, and C. So this is the biggest bucket, A, B, and C. So going by the smallest bucket, B, which is B and C, the entity used to sell this B and C for rupees 8,000. But what is the standalone selling price of B and C? The standalone selling price of B and C put together is 10,000. It means the entity is providing 2,000 rupees discount on this B and C. So first of all, we need to calculate the revised standalone selling price. So how to calculate the revised standalone selling price? So we need to calculate the revised standalone selling price for this B and C. Revised SSP for B and C only. Revised SSP for B and C, right? Let's say existing SSP and revised SSP only for B and C, right? Only for B and C. B and C put together. I hope it is clear to everyone. What is the existing SSP for B and C? 8,000, 2,000. Total is 10,000, right? Clear? What will be the revised SSP for B and C? So that price is 8,000. It means 2,000 element of discount is there. So first we need to allocate. The total is the revised SSP should be 8,000, right? It is 8,000. So how to allocate this? We need to allocate this 8,000 in the ratio of 8:2. So 8,000 multiplied by 8,000 divided by 10,000. 8,000 multiplied by 2,000 divided by 10,000. So the revised standalone selling price comes out at 6,400 and 1,600. Okay. So it means we have allocated discount of rupees 2,000 into this performance obligation into the smallest bucket. So now what is my revised SSP for A, B, and C? A, B, and C. It is 10,000, 6,400, and 1,600. And what is the revised transaction price? The revised what is the revised standalone selling value? It is 18,000. Okay. And what is my transaction price? What is my transaction price, guys? My transaction price is 15,000. So it means now I need to allocate a discount of 3,000, right? Now I need to allocate a discount of rupees 3,000 into A, B, and C on the basis of the revised SSP, which is on the basis of in the ratio of 10, or let's say 100 is to 64 is to 16, right? In the ratio of revised standalone selling price of A, B, and C. So it is pretty simple. If in the question there was a discount element. I mean to say, like in this example, the total standalone selling price was 20,000 and the transaction price is 15,000. It means there is a discount of 5,000. Okay. So if this will be the case, how to do that? So of course, we need to allocate this 15,000. We need to allocate the transaction price into the ratio of 10:8:2. But in the question, one more information is given that generally the company is also selling this B and C put together, and the B and C has to be sold at 8,000. It means whenever the entity is selling the smallest bucket, the entity is also giving a discount of rupees 2,000. So first of all, we have calculated the revised standalone selling price of this smallest bucket. So from 8,000 to 2,000, it comes out to 6,400 and 1,600. So from 20,000, we have moved to 18,000 and we have calculated the revised standalone selling price. And now we need to allocate this 15,000 in the ratio of these three values, which is 100:64:16. Okay. So now we need to allocate 15,000 multiplied by 10,000 divided by 18,000. So this will be the allocated transaction price on this performance obligation. 15,000 multiplied by 6,400 divided by 18,000. Again 15,000 multiplied by 1,600 divided by 18,000. So this will be my 15,000. And what is my allocated transaction price? 83, 33, 53, 33, 13, 33. This is my allocated transaction price, and on the basis of which I need to recognize my revenue, right? So what will be the accounting entry for this? The accounting entry will be, of course, customer account debit to revenue, right? To revenue. Customer account debit to revenue, A, B, and C. So this will be my customer account debit to revenue. At this basis, I need to recognize my revenue, right? To revenue. For product B, 5333. For product C. So guys, you need to recognize revenue only to the extent of transaction price received. Okay. So discount is already netted off, right? So you need not to pass a separate entry for discount, right? You are only calculating the transaction price, and then you are allocating the transaction price into the various performance obligation. So while allocating the transaction price to the various performance obligation, if there is any discount element in the smallest bucket, you have to apply that discount. I mean to say, you have to allocate that particular amount after discount to arrive at a revised standalone selling price for that particular bundle's products, right? And after that, for this transaction price, you need to allocate this transaction price to the revised standalone selling price to the entire bucket, right? Is it clear? Is it clear to everyone? I hope it is clear to everyone, guys. Let me know if you're not able to clear. I will repeat the concept again. 3-4 participants have confirmed so far. Yes, it is clear. Great. So let me give you another aspect of it. Allocation of variable consideration to the performance obligation, right? What is this? Allocation of variable consideration to the performance obligation. What is this? For example, there are multiple performance obligations. So you are a customer. So for example, Namita has entered into a contract with a contractor for construction of his house, for construction of her house, right? So Namita has given two contracts to this particular contractor. One, the construction of her house, and the second, maintenance of her house for a period of 3 years. So there are two performance obligations. One is construction activity, construction of her house, and the second one is maintenance of her house for the next 3 years, right? And Namita has told the contractor that if you will deliver, or if you will complete the construction of this house and you will give us the possession before Diwali, before the festival of Diwali, we will give you 5 lakh rupees incentive as a bonus, right? We will give you a bonus of rupees 5. Now the question arises, if there is a variable consideration or a variable element into the contract, whether this variable consideration needs to be allocated to all the performance obligation, or this variable consideration needs to be allocated only to that performance obligation to which it relates to. So in this particular example, there are two performance obligation. One is construction activity, construction service, and the third one is maintenance service. Okay. So incentive for early completion of house is 5 lakh. Tell me whether this performance obligation is related to both the performance, whether this variable consideration of 5 lakh, the bonus of 5 lakh, is related to construction as well as maintenance service, or it is only related to the performance obligation relating to the construction service. Of course, yes, it is only related to the performance obligation related to the construction service. That contractor will only be eligible to a bonus if he will able to complete the construction before the festival of Diwali, and hence this variable consideration is only related to the construction service performance obligation, and this has nothing to do with the maintenance service. And hence, in case of a variable consideration, the variable consideration needs to be added to or deducted from that particular performance obligation only which it is relating to, It is not allocated to all the performance obligation on the basis of pro rata. Of course, if there is a 5 lakh rupees of incentive and the standalone selling price of the performance obligation is, for example, for construction it is 20 lakh, for maintenance it is 10 lakh, this 5 lakh need not to be allocated to 20:10 ratio. This 5 lakh has to be added to the standalone selling price of, or let's say whatever the transaction price will come out. So it will be added to the transaction price allocated to the construction service transaction price, right? Whatever the allocated transaction price for construction service will be there, this variable consideration will be added into that particular transaction price, right? Understood? Is it clear, sir? If the variable consideration is for the entire contract, in that case, what we are required to do, for example, the allocated transaction price is, let's say, 5 lakh and 10 lakh. So in this case, this bonus or variable consideration has to be allocated in the ratio of that transaction price, right? So let me look at the case study from the institute study material on this aspect. Let me see that if it is there. And for the time being, if you have any query, you can raise your query and you can write down your query on the query link of ICAI. So just give me 1 minute. I am just yes. So let me show you this particular case study. Allocation of variable consideration, right? An entity enters into a contract with a customer for two intellectual property licenses A and B, which the entity determines to represent I hope my PPT is visible to everyone, guys. Sairam, I have told you that the entry for discount will not be there, right? So it is just the calculation methodology, Sairam. Allocation to variable consideration. An entity enters into a contract with a customer for two intellectual property license A and B, which the entity determines to represent two performance obligations, each satisfied at a point in time. So there are two performance obligations, license A and license B, right? The standalone selling price of license A and B are 16 lakh and 20 lakh respectively. So what is the total standalone selling price? 36 lakh. And what is the individual standalone selling price? It is 16 lakh and 20 lakh. The entity transfers license B at inception of the contract and transfer license A 1 month later, right? So first the entity is transferring license B, separate performance obligation is there, and entity is transferring the license A 1 month later, right? Case A, variable consideration allocated entirely to one performance obligation. So first one is, what is the first case? Variable consideration allocated entirely to one performance obligation. So I am talking about the variable consideration which is specific to a single performance obligation. The price stated in the contract for license A is fixed amount of 16 lakh, and for license B, the consideration is 3% of the customer's future sales of product that use license B. For purpose of allocation, the entity estimates its sales-based royalties, that is the variable consideration, to be rupees 20 lakh, allocated the transaction price, allocate the transaction. So guys, in this particular case, the standalone selling price is given as 16 lakh and 20 lakh. So that was standalone selling price. And in the question, it is given that the price stated in the contract for license A is fixed 16 lakh rupees. So don't confuse with the standalone selling price. So that was standalone selling price. Now we are talking about transaction price. And in the contract, the transaction price for license A is given as a fixed amount of 16 lakh. And for the license B, nothing is fixed. It is entirely variable, which is depending on the sales. So it is a kind of sales-based royalty, right? Sales-based royalty, I have told you, it is a variable consideration. So whatever will be the sales, royalty will be that, right? So according to this variable consideration, the entity is estimating that the price should be 20 lakh rupees. So don't confuse that the standalone selling price is also 20 lakh and my variable consideration is 20 lakh. It is different, right? So the standalone selling price is 16 and 20, and the transaction price for license A, it is fixed. For license B, it is variable. And what is it? The estimated variable consideration is 20 lakh. Now the question arises whether this variable consideration belongs to both A and B or only B. So in this case, the variable consideration only belongs to B, and transaction price of A is 16 lakh, and for transaction price of B is estimated variable consideration, which is 20 lakh. Now look at the answer which is given by the Institute study material. That to allocate the transaction price, the entity considers the criteria H per Ind AS 115, paragraph is not important, and concludes that the variable consideration should be allocated entirely to license B. The entity concludes that the criteria are met for the following reason. Why? The variable payment relates specifically to an outcome from the performance obligation to transfer license B, right? First of all, it is only related to license B. Allocating the expected royalty amount of rupees 20 lakh entirely to license B is consistent with the allocation objective of Ind AS 115 also. Why? This is because the entity's estimate of the amount of sales-based royalties approximate the standalone selling price of license B, and the fixed amount of 16 lakh approximate the standalone selling price of license A. Whatever we are expecting, this is also commensurating with the prices, standalone selling price of A and B as well. Okay. So the entity allocates 16 lakh rupees to license A. This is because based on an assessment of the facts and circumstances relating to both the license, allocating to license B some of the fixed consideration in addition to all the variable consideration will not meet the allocation objective H per Ind AS 115. So you cannot allocate any fixed consideration to license B. Why? License B is a separate, license A is a separate. and this license B is only having a variable consideration. License A is only having a fixed consideration. The entity transfer license B at inception of the contract and transfer license A 1 month later. So the entity has delivered first license B, then license A, right? Upon the transfer of license B, the entity does not recognize revenue because the consideration allocated to license B is in the form of sales-based royalty. Okay. Therefore, the entity recognizes revenue for the sales-based royalty when the subsequent sales occur. So when to recognize sales-based royalty revenue? When the sales happen, only then you will be entitled to royalty. Now, for example, I am an author and I am earning royalty. So my contract says that I will be able to 10% of the royalty on the basis of the sale price of the books, right? For example, when the publisher will sell 100 books, I'll get a royalty of 10% on these 100 books, right? So guys, in this particular case, when this sales happen, only then I need to recognize the royalty revenue, right? But for license A, when the entity will deliver a license A for the fixed consideration of 16 lakh, the entity has to recognize when the performance obligation will be satisfied. Okay. So in this particular case, this consideration is fixed consideration was relating to license A and the variable consideration was relating to license B, right? So you are not required to allocate this variable consideration to license A, as well as you are not required to allocate the fixed consideration to license B, right? I hope it is clear to everyone, guys. Namita is asking, sir, in discount allocation 15,000 in pro rata or in the ratio of the revised standalone selling price. So by default, if I'll allocate 15,000 over the 18,000, so by default this 3,000 discount will inbuilt into that, right? Because the final transaction price is 15,000. So guys, case A was very simple. Now coming to case B, variable consideration allocated on the basis of standalone selling prices. So this variable consideration was allocated on the basis of standalone selling prices. The price stated in the contract for license A is a fixed amount of rupees 6 lakh. Okay. What is the standalone selling price? The standalone selling price is given. For A, it is 16 lakh. For B, it is 20 lakh. Variable consideration allocated on the basis of standalone selling prices. The price stated in the contract for license A is a fixed amount of 6 lakh rupees. And for license B, the consideration is 5% of the customer's future sales of product that use license B, right? So fixed consideration is 6 lakh. And for license B, the consideration is 5% of the customer future sale of product that use license B. The entity estimate of the sales-based royalty is rupees 30 lakh. And what is the estimation of variable consideration? It is 30 lakh. Here license A is transferred 3 months later on. So first license B will be transferred, then license A will be transferred. The royalty due from the customer's first month of sale is rupees 4 lakh, right? So in the first 3 months, in the first month, whatever the sale has been happened, so the 5% comes out at 4 lakh rupees. So the royalty due from the customer first month of sale is 4 lakh. Allocate the transaction price and determine the each license and the contract liability, if any. So guys, 3 facts have been given in this particular question. First, the standalone selling price of A and B is 16 lakh and 20 lakh, right? Second, the transaction price stated in the contract is for license A, it is 6 lakh rupees fixed. For license B, it is 5% of the sales value, right? And the variable consideration is 30 lakh rupees, right? So if you see, the total estimated consideration from A and B is again coming out at 36 lakh rupees, right? So the total transaction price commensurate with the total standalone selling price of A and B. Have you understood? Just think about, if the market value of the two product is, let's say, 50 rupees, then why a vendor will sell? Why a vendor will sell at a less than its value? Of course, the vendor will provide a discount, right? The vendor will provide a discount. But the transaction price should be significantly similar to the standalone selling price. ऐसा तो नहीं होगा ना कि मेरा टोटल स्टैंडअलोन सेलिंग प्राइस, टोटल फेयर वैल्यू मेरी 50 रुपए है और मैं उसको 20 रुपए में माल बेच रहा हूं. So this should not be the case. So the standard says that probably the company will not manipulate with the revenue recognition between the performance obligation. So the standard says that the company needs to see, while allocation, the company needs to see if my standalone selling price is not commensurating with the transaction price. For example, in this case, the standalone selling price is 16 lakh for license A, but the entity is selling for 6 lakh rupees. And the standalone selling price is 20 lakh for license B, but the entity is expecting a variable consideration of 30 lakh rupees. What does it mean? It means the entity is manipulating the transaction price between these performance obligations, right? Probably the entity wants to recognize the higher revenue in the earlier periods and lower revenue in the subsequent periods. Probably, yeah, right. I don't know what will be the intention, but yes, there will be a manipulation, and that is why the 6 lakh has been allocated as a fixed consideration to license A, and 30 lakh has been allocated, or I mean to say variable consideration, which is 5% royalty based contract for the license B. And this license A has been sold 3 months after the license B, right? So I need to allocate the transaction price and determine the revenue and need to recognize the contract liability as, right? So guys, in this particular case, just first of all, I'll read the answer of study material which is given by ICAI, then I'll explain this concept, right? To allocate the transaction price, the entity applies the criteria as per Ind AS 115 to determine whether to allocate the variable consideration entirely to license B. In applying the criteria, the entity concludes that even though the variable consideration relates specifically to an outcome from the performance obligation to transfer license B, okay, because that is the customer's subsequent sales of product that use license B. So in this particular case, although this variable consideration seems to be applied only on the license B because it is sales-based royalty. So allocating the variable consideration entirely to license B would be inconsistent with the principle for allocating the transaction price. Why? Why? Because the transaction price is not commensurating significantly with the standalone selling price of these performance obligations. So allocating rupees 6 lakh to license A and 30 lakh to license B does not reflect a reasonable allocation of the transaction price on the basis of the standalone selling price of license A and B for 16 lakh and 20 lakh respectively. Consequently, the entity applies the general allocation requirement of Ind AS. So guys, if the entity manipulated, this is not the new case, right? For example, you came to me and you want to have a FR lecture as well as FR book, right? You want to have that. So you have asked me, sir, what is the price of your book? I have told you the price of my book is 5,000 rupees. And you have asked, sir, what is the value of the FR lecture? I told you 10,000 rupees. So in that case, you have told me, sir, can you do one thing? So, sir, can you sell me this book at 2,000 rupees? Okay. And I will pay you the cost of this FR lecture as 13,000 rupees. So it doesn't make any difference to me because I am getting 15,000 rupees from this customer, from this student, right? And I have, so although the standalone selling price is 5,000 and 10,000, but I have drafted the contract in a manner that I will sell the book at 2,000 rupees and I will sell the lecture at 13,000. Okay. And upfront, I don't want to recognize, or vice versa. I have told my student that please buy this book at 2,000 rupees and my FR lecture will start after 3 months. Okay. And then you can pay me 13,000 rupees. Just get the registration done and you can pay me 13,000 rupees after 3 months. So probably I am doing this transaction in the month of February and I don't want to, I want to record a lower revenue in this particular financial year and higher revenue in the next financial year because I'm expecting that the tax rates will be lower down in the next financial year. Okay, for example. So this 2,000 and 13,000 is not commensurating with the standalone selling price of 5,000 and 10,000, and hence the standard has just protect this manipulation, and standard has told that if the transaction price allocated, for example, in this case 2000 and 13,000, is not a reasonable allocation, does not seems to be a reasonable allocation in the proportion, or let's say in relation to the individual standalone selling price of these performance obligation. So standard has told that, guys, don't go by that. Just put this contract as a 15,000 rupees contract and allocate this transaction price, this 15,000 rupees, on the basis of standalone selling price of this contract, right? It means whether it will be a variable consideration of 30 lakh, fixed consideration of 6 lakhs, the entire 36 lakh has to be allocated in the ratio of 16:20, right? So in this case, this will come out as a 16 lakh and 20 lakh at the end, right? So the entity allocate the transaction price of 6 lakh to license A and B on the basis of relative standalone selling price of 16 lakh and 20 lakh respectively. So how this 6 lakh has to be allocated? 6 lakh divide by 36 lakh multiply by 16 lakh, right? And how this in the next performance obligation license B, 6 lakh multiply by 20 lakh divide by 36 lakh. And how this 30 lakh has to be, allocated? Again, 30 lakh multiply by 16 divide by 36, 30 lakh multiply by 20 divide by 36, right? So the entity also allocates the consideration related to sales-based royalty on a relative standalone selling price basis. However, when an entity licenses intellectual property in which the consideration is in the form of sales-based royalty, the entity cannot recognize revenue until the sale event has been taken place. For the purpose of license A, it is a point in time. For the purpose of license A, this allocated transaction price, this allocated revenue needs to be recognized. But for the purpose of variable consideration, of course, it has to be allocated on the basis of standalone selling price of 16:20. But when it is going to be recognized? When the sales will happen, right? So license B is transferred to the customer at the inception of the contract, and license A is transferred 3 months later. When license B is transferred, the entity will recognize a fixed revenue. What is that? 6 lakh multiply by 20 lakh divide by 36 lakh, which comes out at 333, right? When license A is transferred, the entity will recognize a revenue of 6 lakh multiply by 16 divide by 36, which comes out at 266,667, right? And in the first month, the royalty due from the customer first month of sales is rupees 4 lakh. Consequently, the entity recognizes a revenue of 222. How come it is possible? 4 lakh multiply by 20 lakh divide by 36 lakh. Okay. And so this is in the first month. Since license A has not been transferred, so there will be no revenue recognition from license A. But for license B, 222 is going to be recognized, okay, which is allocated to license B. The entity recognizes contract liability of 177,778. What is that? 4 lakh minus 222. Okay, or you can calculate like that: 4 lakh multiply by 16 lakh divided by 36 lakh, it will comes out at 177,778. So that will be allocated, that will be shown as a contract liability. And when this contract revenue has to be recognized? When license A will be transferred after 3 months, right? So this is because although the subsequent sale by the entity customer has occurred, but the performance obligation to which the royalty has been allocated has not been satisfied, which is license A. So guys, in this particular case, you need to consider 3 aspects. First, you need to see if there are multiple performance obligation and there are fixed consideration as well as variable consideration. You need to see whether my transaction price is reasonably commensurating with the standalone selling price. If answer is yes, then you need to allocate variable consideration only to the performance obligation to which it relates, like in case A, right? But if the transaction price of the performance obligation is significantly different from the standalone selling price of the performance obligation, then you need to see this contract as a single contract, and you need to allocate the fixed consideration to the entire contract on the basis of standalone selling price of those performance obligation. Like in this case, what we have done, 6 lakh multiply by 16 divide by 36 for license A, 6 lakh multiply by 20 divide by 36 for license B. And for license B, this fixed consideration revenue has been recognized upfront, And likewise, for variable consideration, we need to recognize revenue when the sale will happen, like it is sale-based royalty. And we need to allocate this variable consideration into A and B on the ratio of their standalone selling price, like 4 lakh multiplied by 16 divided by 36, 4 lakh multiplied by 20 divided by 36. For license A, we have recognized a contract liability. Why? Because the performance obligation, because the price which is relating to the performance obligation, that performance obligation has not been satisfied. This license A will be transferred after a period of 3 months, right? And hence we have not recognized this 177,778 or fixed consideration of, let's say, which is in this particular case, which was 266,667. This will be recognized when this license A will be transferred after a period of 3 months, right? So this was how to allocate the performance obligation, how to allocate the transaction price into the performance obligation. I hope you guys are able to understand. I hope you guys are able to understand this part. Guys, I have covered this step number 4 as well. And in the next class, we will move to step number 5, right? So I'm just taking a 15 to 30 seconds pause and I'll wait for your query. If you have any query, we will do that. Otherwise, I'll conclude this class today. Yeah. Yes, Utkarsh, you are right. In case of a discount, first of all, you need to see from the entire contract if there is a small contract, a small bundle. So first, you need to calculate the revised standalone selling price of that particular bundle, and after that, you have to allocate the transaction price in the ratio of revised selling price of all the performance obligations. In case of a variable consideration, yes, money. In case of a variable consideration, you need to see variable consideration is related to which performance obligation. If variable consideration is related to a particular performance obligation, you have to apply that variable consideration while allocating the transaction price only to that specific performance obligation. But you need to see one aspect from the concept of the entire contract. You need to see that if you are allocating a transaction price to multiple performance obligation, you need to see, is it reasonably similar to the standalone selling price? If it is not reasonably similar to the standalone selling price, in that case, you need to apply the entire transaction price. You need to allocate the entire transaction price into the standalone selling price of these performance obligation, right? Clear. So you need to just do this illustration number 56 to better understand and revise the allocation of variable consideration, where both the cases are given, where it is related to one performance obligation and it is related to multiple performance obligation, right? So I have covered this concept with the help of a lot of examples and 2 illustration with the institute study material. And of course, this is one illustration from my side, okay? And apart from the small illustration and case studies from my side. Thank you very much, guys. And I'm not looking at any query once again. Namita is saying, sir, please explain my discount related query again. So Namita, in that particular case, the transaction price was 15,000 and the total standalone selling price was 20,000, right? So first of all, from 20, we have arrived at 18, right? By giving a discount to product B and C. So the revised standalone selling price is 18,000. And Namita, please try to understand, we are not recognizing revenue on the basis of standalone selling price. We are recognizing revenue on the basis of transaction. But we are using standalone selling price for allocating the transaction price, right? So in this particular case, the transaction price is 15,000 only. So that is why we have allocated 15,000 into the individual standalone selling price, which is aggregating to the 18,000, right? So by default, we have given or we have inbuilt or we have factored a discount of 3,000 into the performance obligation A, B, and C. Okay, Namita, I hope you have understood this. So there is no separate entry for discount. The only thing is by calculating the, or let's say, while allocating the transaction price, the discount has already been factored, right? Clear? I hope it is clear, Namita. Let me know, otherwise I'll explain it again. Thank you, guys. Thank you so much. Stay happy and healthy. So today we have concluded fourth part on Ind AS 115, and the next class will be day after tomorrow. It is on Saturday, and we will do the fifth part of Ind AS 115 day after tomorrow. And we will also upload a recorded video, which is part 6 and last part of Ind AS 115. So this 115 will be scattered over 6 classes, right? So thank you so much, guys. Stay happy, stay healthy. Bye-bye. Take care.